camera blocking you guys' view too bad, I can lower it. You guys are good?
Test, test. Testing 1, 2. How's everything sounding? Test 1, 2. Everything sound good.
We are about ready to start, yeah. We need to stand in a certain, stay in a certain area. I tend to wander though. Feel free to interrupt me too. Isn't that first breath? I forget anything or chime in. You ready?
You're good, yeah.
Okay. Okay, I think we'll get started. Get out of here. Thank you for coming. We're going to keep this really informal. The bathrooms are just out the door to your left. Coffee, pop back there, cookies. Get up whenever you need to. We're not really going to take formal breaks because we have a lot to cover. We want you out of here on time because it's, again, not a great weather day. So yeah, and ask questions. Feel free to just jump in and ask a question anytime. If in your packets, the left side is the agenda and all the PowerPoints we're going to cover today. And the right side is just more general information for you. There's some other products we offer and a really nice kind of intro to marketing packet the Minneapolis Grain Exchange put together. That is a really nice, just basic introduction to futures and options. My name is Amy Ryan. I'm the agency manager at Martin Ag. So I run the crop insurance side of things. And what I want to talk about is tying together crop insurance and marketing. And we've been talking a lot in our office this year that I think a lot of us are guilty when we look at crop insurance, we're only looking at premium. And we're not really thinking of, well, we're just looking at, I want to pay this much per acre. We're not really thinking about what you're getting for that. So we're trying to kind of flip the equation. And let's talk about how many bushels do you want to raise and how many bushels can you protect with insurance? So just an example, I just made up a corn example in Cass County. So you add all those up, divided by 10, we have 128 bushel approved yield here. Not great. At a 75% guarantee, which is a really common level of coverage, you've only got 96 bushels an acre of coverage. Let's say you plant 500 acres of corn in that unit. That's only $48,000 of coverage, or 48,000 bushels of coverage you have. But your goal is to harvest 180 bushels on this unit. Take that times 500, you've got 42,000 unprotected bushels if you hit that 180 yield target. And that's why we want to start thinking about crop insurance is, what's your target? What do you have left unprotected? What can we do to make that number smaller? So on the crop insurance side, there's really three nice tools we have for that. There's a yield adjustment, which is replacing any poor yield with 60% of the county yield from that year. The trend adjustment, I think you're all familiar with too. Every county has a factor. You take that factor times how old the crop is. We add that to your APH. And then yield exclusion is newer. That is only if the county overall had a bad year. So it doesn't matter. You could have got hailed out. If the county did great, we can't pull that yield out. And that's just all. RMA makes a list and says, these are the years you can pull out. So here's that same example. We have that 128, which is an awful look at APH. 1996 and 2004, you got hailed out completely. Unlikely, I know, but for my example, it works. The T yields back then were horrible. So 60% of the T yield in 1996 was only a 30. Didn't gain a lot of ground there. But we did move that approved yield from a 128 to a 136. We gained some ground. So now let's put trend on it, TA trend adjustment. The TA factor for Cass County corn in 2016 was 2.5. And how TA works is that yield in 96, you take 2016, the crop year I was doing this for, minus 96 is 20 years, or 30 years, 20 years, Take that times 2.5. We're going to add 50 bushels to your yield. And they did that because obviously with these new varieties of corn, your yields have gone up so far so fast, and these old yields are really dragging your APH down. So 96, we're going to add 50 bushels. 98, we're going to add 45, and you just keep doing the math all the way down. We've taken that 136, made it a 163. Now we've added some bushels to you. And now YE is that yield exclusion. In 2004, RMA says 2004 corn in Cass County, you can pull that yield out. That wasn't really frost year, so most counties have 2004 that we can pull out. So that zero yield, we did the YA, did the TA, got up to 83. Well, we could just throw it out now. So now we're just going to ignore it, add these up, divide them by 9 instead of 10, because now we're only going to use 9 years. Now we're up to 172. Now, obviously, you don't get this for free. That 128 yield that we started with at the very beginning is what your rate is going to be based on. And basically, the lower the starting yield, the worse your rate's going to be. So you're going to pay the rate at 128, but you're going to get your guarantee based on the 172. The rule of thumb is the bigger that gap gets between those two numbers, the more expensive it gets. And that's very case by case. You know, we just do the quote with and without so you can see what the difference is. But usually it's worth it because we've brought your APH up so much that it's worth that extra premium. So we started with the 128 APH, and we had that 42,000 unprotected bushels. Well, now we've jumped our APH up to 172. At 75%, that's a 129 guarantee. Now we've got 64,500 bushels of coverage. We're down to just 25,500 unprotected bushels if you're gunning for that 180 yield. So we've lowered it considerably, but we still have 25,000 unprotected bushels out there. Hardly anyone takes yield protection, but I did want to point this out. Yield protection for these revenue crops, you know, we look at the whole month of February, we look at the futures prices, we set those prices March 1st. With yield protection, it's that price that's set March 1 is your price for the whole year. There's no price movement. That's why yield protection is cheaper than revenue protection. Revenue protection, then again, adds that price protection. So your guarantee is going to always be the higher of the March price or the harvest price. What you harvest, your production account, is always taken times the harvest price. So now you've got some price movement protection. So if the price starts at $3 in the spring and it goes up to $4 in the fall, on RP, we're going to recalculate your guarantee at $4. We don't charge you any extra premium. It's built into the program. And we take what you harvest times $4. If the price starts at $3 and it goes down to $2, your guarantee stays at $3, your production account is taken times $2. If you're going to do any forward pricing and everything Randy's going to talk about, you have to have a revenue protection policy because we want that price movement built in. So we've got the 25,000 bushels sitting out here. How else can we get that number down? Well, you can put crop hail on it, which again, you don't think of that as bushels, but you think of it as $100 of coverage per acre, but we can kind of back into bushels for that. Think of it that way. We can do production hail, or we could look at whole farm revenue protection. Production hail, some of you are probably pretty familiar with this, and probably some of you aren't. As long as you have a 65% or higher policy, you could take production hail. And what that does, it covers from where your revenue protection policy leaves off up to the level you choose. Could be as high as 120% of your APH yield. So this example is showing if you took an 80% level, it only covers 80% of your APH. So from 80 to 100 is uncovered, and then from your APH to whatever you actually are trying to harvest is unprotected. If you take a regular crop hail policy, a basic, a DDA, you're kind of paying double for this bottom part. You're going to get coverage up here, but then they're both going to pay, which isn't a bad thing. You know, you get 2 payments, but you're also paying 2 premiums for kind of the same coverage. So the idea with production hail is you can cover just this top part. It pays out kind of like a companion policy. It's going to pay out very quickly, and at about, you know, a 35%. If you took a 75% policy, like a 35% loss, it's fully paid out. And we'll go through an example. Production hail does have a sales closing date. Varies by company, so if this interests you, you have to look into that. You can't buy this in August. Crops vary by company. Usually you can pick any factor from 100% of your APH to 120%. It gets expensive. The price is based off the base price for, in this case, corn, the RMA price. What RMA sets March 1, that's the price they use for production hail. You can lower that percentage to bring the premium down. You have to have a hail loss to collect. It's a hail policy. The 2 things you have to remember on this one, they will pay the lesser of, so if you have a hail loss in June, they'll go out and appraise it. And let's say they say you've got a 10% loss out there. So they'll take that down, note that. They have to wait until harvest. You harvest that crop, they look at the numbers they get and say, well, what percent of a loss did you have based on what you harvested? If it was only 8% or 7%, that's all they're going to pay you on. So if the crop comes back, you'll get paid less. You'll never get paid more than what they appraised it at. So if there's a drought and your bushels are go to 0, you're still only going to get the 10% hail loss. It only covers the hail. And again, because they need to see your production, they can't pay these until fall. So that is one downside. You won't get any payment until after harvest. So back to our example, we jumped that APH up to 172. We had those 25,000 unprotected bushels. Now with production hail, we take that 172 APH times a factor up to 120. I'm just going to choose 110 because that kind of fits right where I want to be. That gets me a production hail coverage of 189 bushels. So if you harvest below 189 bushels and have a hail loss, you will get a payment. Again, take those 500 acres times that 189, 94,500 bushels. You subtract that from what the MPCI policy covers. We're going to have 30,000 bushels of coverage on that production hail policy. We're actually over now. We only had 25,000 left to protect. We're over that, it's fine. You could have gone up to 120 and had another 10% coverage. So, I mean, if you get hail, this pretty much can, if you have a good APH and you have a hail loss, this can almost guarantee you'll have a pretty decent hail payment. You would not want to take this if you have some really poor looking APHs because you will outproduce it. You'll outproduce your coverage. You probably can't read that. The payout for this is a little strange. So we took that 172 yield times last year's corn price of 386 times that 189.2 bushels we came up with. Your coverage per acre is $232. That's your max. That is going to cost you $50.31 an acre, which is not cheap, but it pays out so fast if you have hail. And if you don't like that $15 premium, you can take that 386 corn price and you can lower it to $3 or $2.50 or whatever you need to get it down to so it's premium you're comfortable with. We want to keep that trigger as high as we can. And then we can pull the dollars back. So the rate per acre is $6.60 if you want to think about how like a basic works or something. At $100 of coverage, it would cost you $6.60 an acre. And this is from RCIS. They have a really great hail quarter. I could have added a basic and a DDA and everything side by side, and you can see how much they cost and how fast they pay out. So what you notice with this is at a 35% loss, it pays out the entire $232. So if you have a 35 or a 40 or a 45 or a 50% loss, it doesn't matter. You max out at 35. And that's the whole point of this, because the 110 factor minus your 75 RP, that's the 35% you're covering. So it's only covering that top portion that your RP policy doesn't cover. And if you haven't heard much about production hail, this one takes a while to wrap your head around. It's really different. It's kind of grown on us over the years. I wasn't a big fan of it when it first came out. And it's, again, not going to be a fit for everyone. You have to have good APHs for this to work. If you've got some really poor looking APHs, it's probably not a good idea. Yes.
You mentioned that they have, you mentioned the company that has it. Is that available to anyone to go online and look?
That is within the agent portal. Most of the quoting is agent restricted. Every crop insurance company has some version of production hail. They all have their little tweaks to it, so it's slightly different everywhere you go. Some places will cap your yields, and with that trend adjustment, it's pulled those yields up so far. Some companies don't let you take full advantage of that. They won't let you use the trended yield. Again, that's really company by company. And for some reason, actually 105% would have been right exactly where I wanted to be to cover those bushels. RCS doesn't offer a 105. They just have 100, 110, 115, and 120. So you do kind of have to shop around to the production hail. You don't have to have this with the same company that your RP policy is at. It makes it easier, but you're not required to have it. Whole farm revenue protection, I'm going to talk about for about 2 minutes. We're going to go into it deeper at the end of the day. But just to talk real quickly, whole farm revenue protection is basically based on your Schedule F and what you plan on doing this year. It's ensuring the total revenue on your farm, all your crops, all your animal products. So if you have cattle, you can use this to cover both your cropland and your cattle. We like to think of it as an umbrella policy. Kind of sitting on top of your RP. We're not going to cancel your RP policy. This is going to sit on top of it, kind of cover everything. So again, just a quick example about these unprotected bushels we have. Our RP policy was a 172 APH at 75%. The price last year was $386. We've got $248,000 of revenue coverage. What's nice about whole farm, like I said, I'm going to get into this in detail at the end of the day. But you can cover what you say you can insure. We're going to gun for that 180. You can put that down that that's what your goal is, and they will cover that if you have proof that you've been growing yields that good. They'll look at your APH. You can't say I'm going to grow 250 bushel corn because you can't support that. Let's say you did do some forward selling and you can show overall you're getting a $4 price instead of $386. We can use that. So in this case, you'd have $270,000 worth of revenue coverage in addition to your RP policy. So that's just another way to cover some of those unprotected bushels. And like I said, we're going to talk about that at 1:30. So our goal this year, I think, is we're going to try to change the way we think about buying crop insurance. You want to think about it as just one more tool in your whole risk management package. You want to think about how many bushels you're protecting. How many are left unprotected? How can we maximize that and not cost $50 an acre? And then again, if you're doing any forward pricing, you have to have a revenue protection policy. And that is all I have. And now Randy's going to jump in.
Okay, just to let you guys know a little bit, we're streaming this live on the internet, Facebook and YouTube. So, you know, if you guys want to do a shout out to somebody, that's fine. But clicker. Part of what Amy was talking about is just to take a step back and look at just, you know, your production that what you're going to have for production for the year, and then also how to protect it. Part of the basis of using
marketing is using our crop insurance to give us the bushels that we can actually market without much risk. And, do I hear it? I guess not. I got to hold up here. Technical difficulties. Is that better? Okay. So what we're really trying to get at is that how many bushels can you market ahead of actually having the bushels without having risk? Using crop insurance is one of the bases that we want to kind of hammer, is that that's where you start. Figuring out cost of production, that's one of the things Scott will talk about with Cash Cow here later this afternoon as well. So it kind of gives us the basis of our steps or our foundation of how we want to move forward with looking at doing, how to do marketing and how to come up with our bushels to sell. Just to get you guys in the mood and tell you what the markets are doing. Maybe you don't want to know. Big report coming out tomorrow. That's going to, well, it's not a big report. It's going to be kind of a lackluster one. I'll talk about that a little bit later. But what's interesting is we got a dollar that's up almost a full cent today. Crude's up 57 cents. I'm going through the highlights first. So wheat that nobody cares about is up about 5 to 7. But we're looking at soybeans down about 20 cents right now. And corn is down about 4. Cattle are down over $1. So we've got a little bit of pressure coming, a little bit of selling coming into the market today after seeing a pretty good push. So now I'm going to take a step back and just look at the basics of marketing. Where you start at, how you move through this, and how you get to the end result, and kind of things to look at, and it kind of helps to how you develop a marketing plan. There's questions, ask them. I will get somewhat, I'll go off task. I'll try to get back every once in a while. So looking at it, I always like to start with this when I start meetings and just basically show what the markets have done for the year. Now, if you look back at the start of this year, 2016, this tells us basically what each of our markets have done. I don't know if you can see it very good in your print-offs, but looking at soybean oil is up about 20% for the year from January 1st till now. We're up 17, almost 17.5% in soybeans. Oh, canola is up close to 8%. Trying to find, corn is down about 9%. That's a, think about that for a second. You've got soybeans up close to, what did I say? 17.5%, but you've got corn down. Those two normally don't see, they normally don't track that far apart. That's going to be key on what we're going to look forward to as far as 17 is concerned. And that should give us a little hint of what we need to look at as far as our 17 marketing year. Wheat is close to the bottom. Kansas City's down about 25%, and spring wheat's down about 5%. Big disparity as far as winter wheats and spring wheats. And that's one of the things we'll talk about as well, is because you're looking at the world needing quality wheat right now, and it's kept our spring wheat prices a little bit more inflated than what they probably should be. But we're not seeing that pass down as far as cash is. So I'll get to talk a little bit about all that a little bit later. So, and again, if there's questions at any time, ask them. Because it'll help to keep things going. First thing we need to do to try to figure out is how are prices set? I mean, basically, what sets your cash price that you're going to be looking at selling your product for? And really, when you look at it, you have to watch the futures market and its basis. The basis is what's charged at the elevator. So cash is basically, today's cash price is the front month futures contract minus, plus or minus your basis, plus or minus quality, and that gives you your cash. One thing that guys get kind of caught up in is that when they look at forward contracting, how to figure out what the price should be if you're not don't want to sell your corn today, what it's going to be in 3 months from now. Think of it as today's cash. Cash today should be equal to cash tomorrow, except for the carry in the market. That's a simple way to look at it. And we'll cover some of that a little later. Now, futures basically is the foundation of what our price is. Some of this stuff actually is in that Amy mentioned in the Minneapolis Grain Exchange pamphlet that you've got. A lot of this came out of that, and that kind of gave me the basis of this. So, but looking at futures, it's the legal definition is a standardized legal agreement to make or take delivery of a standard product at a specific price or at a specific time of a commodity. Now, it only exists when one party buys and one party sells. So you have to have a buy and a sell. That's basically how you get your open interest, your volume. Now, what futures does is it takes your collective expectation of future supply and demand. Wheat right now is running higher. Minneapolis wheat is running higher because of the expectation that they need quality wheat. So you've got a bunch of commercial firms out buying spring wheat at this point on the expectation that they're going to need it to blend with winter wheat or to blend or to ship to foreign countries, because Europe had a bad crop, Canada had a bad crop, Australia's having a good crop, it looks like. But the expectation is that that need for spring wheat is going to be there. It's not there yet. So once you start to see the futures market drift a little bit, or you start to see cash improve, we're going to see futures start to roll back, because then all of a sudden it starts coming in the cash market and they start getting the product. So we have to watch for that little bit of turn when that happens. Same right now in soybeans. This one has got guys scratching their head more than, I think I've lost half my hair in the last 3 months because of this. We've got a 480 million bushel ending stocks estimate in soybeans. So why are soybeans sitting up at close to $10.50, $10 where they're at? It's a hard explanation. They really shouldn't be up as high as they are, but it's the perception again. Last spring, we rallied a soybean market $3.50, not off of anything that, any reason that we needed to rally soybeans. It was because of one thing, and that was Argentina was a little bit wet. They're having trouble getting their harvest done. The expectation, or the thought, was that they weren't going to get all the beans harvested. We weren't going to get soybean meal produced. We wouldn't be able to supply the world with soybeans. Argentina supplies about 50% of the world's soybean meal. They export that much. So the idea was that they needed to come to someplace else to buy the beans to get the meal made, to make their demand. I told you guys I drift off, so I'm drifting right now. But looking right now, you've got an Argentina that's having a little bit of a problem. They're dry. Brazil's having really good luck. They're getting rain, the production's going well. I mean, it looks like right now they're actually saying that harvest should start about a month sooner than normal. And they're looking at having some pretty good supplies of soybeans. We'll see tomorrow what USDA says, but right now the average estimate has about 102 million metric tons, which is up from last year's 93, I think it was at. So we're looking at a pretty good increase in production. Now, you've got 480 million bushels stocks for us. You're looking at them increasing their production by close to 5 million metric ton, maybe when it's all said and done. The likelihood is that we're going to see a pretty large world ending stocks estimate for soybeans right now, right? South America isn't really had a good reputation of being able to meet demand on a timely basis. The United States does. So again, our demand has been fairly strong. Expectations right now are for our exports to China to be close to about 32, 33 million metric ton, and we're at about 27 right now. We don't have a lot more to sell them before they switch their demand over to South America. South America starts exporting sooner. You know, if they start selling in January, that should start to bring our market down. So right now we're seeing a pretty good push because of the expectation that demand's going to stay in the United States and that there's going to be some issues in South America. Reality isn't showing us that, but the expectation is showing us that, and that's why we're seeing soybeans hold some pretty good value. Speculators are also trading that soybean market a little bit stronger than what they, because soybeans have a little bit more volatility, more speculators play that market. We're in what we're calling right now kind of the Trump effect. We're seeing a little bit of our economy see a little bit of inflation, and the dollar's running pretty good. We're seeing some pretty good strength. So that's helping to also push soybeans up, because you're seeing a stock market that's rallying. You're seeing a lot of investor money coming back into the market. So that's another thing that we're looking at. Okay, now futures. The nice thing about that, what started the futures was back in the 1800s when the millers needed to buy wheat, and they would go out and buy in the countryside, but nobody really knew what the prices were going to be. So they decided to come with a standard contract. So wheat, well, eggs started it. Wheat was the next one to come with it. But it really, what it amounts to is a standard contract that specifies quantity, quality, delivery time, delivery place. Price is the only part that's negotiable. This is the part I don't like, is that we've gone mainly to just be electronic trading right now. We don't have open outcry that much anymore. I like the open outcry kind of more for the romance of it, I guess, more than anything, because You know, when you go to the pits, how many guys have ever been to the Chicago Board of Trade or to the Minneapolis Grain Exchange? I mean, it's kind of fun when you see a bunch of guys yelling at each other, pushing and shoving, and there's actually, it's organized chaos. Now it's a bunch of computers that are blips, you know, so it's not so fun to watch anymore. So, but when you do futures, there's risk involved with futures. And that's why there's margin requirements that are tied with it. Initial margins and maintenance margins. Initial is kind of the performance bond, the good faith money that you have to put in just to play the game. Trading futures and options are different than trading stocks. When you buy a stock, you pay 100% of it, right? You have to pay 100% of the value of the stock. With futures, you pay about 1/5 the value of the commodity. And that's why you sometimes have margin calls. Speculators, or when the funds get in and when they actually trade, they actually pay 100% of the value. Funds will not make margin calls. They basically will pay 100% of it and they'll ride it. And that's one of the things we're also seeing. Funds are pretty heavily long right now in the soybean market. They're short the wheat and they're short the corn a little bit. So margin calls happen when the market moves against you. So if you've been holding short soybean positions, which a few of us have, you're paying margin calls right now because the market's rallied out. Today actually is a little bit reprieve. I like today. So today's helping me. So I'm actually in a better mood. Not my bias there at all, but you look at the futures market, you basically have two types of futures market. You have a normal market, which that means there's a carry. Now, what's nice about a market, the futures that has a carry, is that it's paying you to store your grain. For you guys that are holding corn, it's a good thing because it's paying us to hold corn. It actually, this is the first year, and I think in the last 3 or 4 years, where you actually have full carry, which means that our December contract to our July is roughly about 27 to 30 cents. It's been the best that we've seen in the last few years. So it's actually paying us to be able to hold our corn. Inverted market, there's no carry. Basically what they're saying is we're going to give you more today than we're going to give you tomorrow. When you look at those markets right now, it's just kind of an example. Corn is paying a pretty decent carry. I mean, from December to March, you're looking at about close to 7 3/4 cent carry. This is as yesterday noon. For May, you're looking at about a 6.5 cents from March to May, and then to July, 7 1/4. So what's that, 14, 20, 24 cents it was yesterday? 25 cents, something like that. It's enough of an incentive to store corn and look at marketing a little bit farther out. Soybeans, first time in a long time, we've actually seen a carry in soybeans. Normally that market's been inverted. It hasn't paid us to store. So right now, it is actually, look, we've got a 10-cent carry from January to March. It's enough to push your sales off to a March contract. Just enough. And we would look at basis to improve a little bit there too. When we look at inverted markets, you know, where they're not paying us to store, Minneapolis wheat is not paying us to store. So right now, Minneapolis is telling us we'd rather see the quality wheat brought to us now. We'd rather see wheat than you put it in a bin and hold it. And it's actually 6-cent difference between the December and the March contract. The market is expecting, though, in the bigger your supply, the bigger the carry is going to be between the months. And that's why corn has got a little bit of a carry, and that's why soybeans this year has a carry, because we got that 480 million bushel stock. So the more supply you have, the more likely it is they're going to pay you to hold it, because they'd rather not, the market would rather not get it. They'd rather you hold it and wait. Oops. Okay, now there's two different types of traders. Now, we like to do things in twos, I guess. So looking at it, you have the speculators. And that's anybody who doesn't have an actual risk of the commodity. You know, somebody who doesn't, somebody who's just in it to make money. Funds, locals are part of it. Those are guys that actually trade their own account. They used to be floor traders, and then you have the funds. Now the funds are basically guys that just want to go in and banks do it. A lot of what am I thinking of? Hedge funds are involved in the commodities now, and they reallocate every month. So you start seeing a lot about the Goldman Sachs role. You'll hear about that. You'll hear about funds reallocating. At the end of the month, they have to make sure their portfolio is equal to what their perspectives say, and that's where you see a lot of the rolling and a lot of, it can be a little bit of changes towards the end of the month, beginning of the month activity, but And then you have the hedgers. Basically what you guys are hedgers, or elevators are hedgers. Anybody who actually has a stake in the commodity or in the product. So. Did you get it done? Okay. Now, there's two different types of hedges. There's looking at your short hedge, that's a sell. I mean, that's basically what you guys are needing to do. Your job is to produce a product. Your job is to sell a product. So our idea is that we have to look at selling this at some point. So we actually look at try to transfer the price risk from the producer to somebody else. And we look at either doing that with doing futures or looking at it with options or cash. Basically, what a short hedge or a short sell is means that you're long the physical commodity and you want to transfer that risk to somebody else. So also, if you're a cattle producer, you needed to buy grain or a merchandiser. I'm going to digress again. Look at how much open interest there is when you look at the commodities that trade, and that is kind of mind-boggling. You know, we raise roughly 4 billion bushels of soybeans, and we're at about what, close to 15 billion bushels of corn. But when you look at the volume of what's traded, or what our ending stocks is, it's like 3, 4, 5 times what we produce. And you kind of wonder, how do we have that much volume out in the market that doesn't have that big of supply, right? You look at all the hands that touch that grain. I mean, you have a farmer, you have an elevator, you have a processor, you have a feedlot, you have a feed manufacturer. There's 5, 6, 7 different times that grain can be touched by different individuals. And all of them at some point or time need to hedge or need to protect themselves. And that's why you see volume and you see the open interest as big as it is. And some of that is when you look at the merchandisers, basically the ones that need to buy the product for a future date to try to make some wheat millers. So all of them have to come in and protect themselves at some point. Elevators really, their job is to be flat at the end of the day. So they're supposed to be hedging that they have, whatever they buy at the end of the day, they need to have sold. Their risk usually stays in the basis side of the market. This is what a lot of elevators work on. So you basically have two positions. One of them is a short cash position. Basically, you need to require the product, and you're looking at a long futures contract. So now, futures are hard to peg. I mean, we have a lot of different things that, and we've become in the last 5 years a lot more global than we used to be. I mean, it's not just watching what goes on in our backyard and what happens here anymore. We have to pay attention to what's going on in South America. Russia has gotten to become a lot bigger player, especially when you look at it as far as the wheat market is concerned. There's a lot bigger range that we have to look at because of the exports and value of dollars and different political realms that are taking place. But the things that basically affect us are fundamentals, technicals, and then of course the funds in which direction they want to go. So, fundamentals, supply, production. It's what you guys do. Acres and yield projections. We also need to look at demand, the use side of things. This year, you know, corn was a surprise to a lot of people because who would have expected that we would have seen a almost 6 million acre increase in corn production? Never in my wildest dreams would I have expected we were going to increase acres by 6 million. Expected to see close to 3 to 4 million, but we didn't expect to see that. And then you see a yield that we got, which is almost it's a record, and a lot of states had record yield set this year. We bumped our production up over 15 billion. Wasn't that many years ago, we didn't think we could produce a 10 billion bushel crop, and now we're at 15. Now next year, of course, we'll see a little bit of a pullback. Demand is another one. I mean, you look at the demand factors that are out there. We're not quite to our highs that we've seen back in the early 2000s as far as feed demand or as far as exports for corn, but we pushed up our ethanol demand and we pushed up feed demand pretty decent. It's not quite peaked yet. Soybean demand has been astronomical. Every year we set records for crush and for exports. And a lot of the exports, of course, are coming out of China. How many of you guys remember in 2008 when we were looking at needing to expand our corn acres because of ethanol? Ethanol was starting to come in to be a big play. We needed to get more corn acres. And we actually expanded our corn acres tremendously in 2008. At that time, the expectation was that corn was coming to the US, soybeans were going to South America. That most of the corn would have to be raised here because we have better logistics, we have better able to move the corn, a lot better than what South America does. And we were actually going to start pushing our soybean acres that direction. And look how much that's turned in just 8 years, where now all of a sudden our corn acres seem to be somewhat kind of finding equilibrium here, maybe a little bit high right now, but our soybean acres are nowhere near where they need to be at because of the demand. And you look at what wheat acres have done in the last, well, since 2000, early 90s, we've dropped wheat acres, what did I say, close to 20 million. So we've taken a lot of wheat acres out of the United States and it's all gone towards corn and soybeans. We've changed the dynamics there. All of that goes into play with what our demand has been at and where because we've actually been able to produce and have a lot more demand towards corn and soybeans. We've switched our acres over that direction. Technical analysis is another thing that we watch. I mean, I don't want to get too deep into that, but just to touch a little bit because it's important to see and to follow along with. You have to watch indicators. You know, I watch daily, weekly, and monthly charts depending on what the purpose is, to what the information I need to get. Daily charts are good to look at, but it's too much emotion because you just get so much. It's the herd mentality, and when you look at what on a day-to-day basis, it's just too much to look at to try to figure out a trend in the market. You can figure out support and resistance in some levels, but if you're looking at setting up a marketing plan and setting up a way to do, like when Scott and I get together and we do our marketing plans for customers, I try to stay away from looking at daily charts because it doesn't tell you a lot. It doesn't give you the whole story. It gives you what's going on today. Weekly charts and monthly charts give you a lot more to look at it. The trouble with monthly charts right now is that because of the spike up we've had just recently in these markets, it kind of skews what the real ramification or what the real trend of the market could be at. Because we've had 7 years of really good push, and we had the years before that were a little lower. So it's hard to really figure out your top third of the marketing very good when you look at the monthly charts. Weekly can give you a little bit of an idea there, but so it depends on what you're looking at and what you're trying to accomplish by looking at charts. For the most part, for you guys, for producers, look at weekly charts. Take some of that emotion out of the market, because the day-to-day stuff isn't what you want to see. It's kind of like seeing the trees before the forest. I tell guys, maybe it's not good to read daily comments every day because you get caught up in the emotion. Not that you shouldn't read our daily comments. I'm just, just saying. But when you look at technicals and watching what they do in watching trend lines, usually an indicator is 2 closes outside of a trend line means there's a change in a trend. This has not followed through this year. I was watching this, even soybeans. A couple of times we've traded over, above support. It doesn't mean that we're going to keep going. The market turns. Right now, today is an example of that. We actually traded a little bit above support the last couple of days, and now we're trending down a little bit. So there's you have to watch that a little bit, but that's general rule of thumb, and it's something to watch. Now, well, I should have actually had some charts up here to show trends, but yeah. Looking at support and resistance, basically what you're looking at there is to find out levels that this market goes to. And resistance is on the top side. It's basically where you think a market can trade up to. Right now, I'm looking at, for January soybeans, I think it's a 1065 level is kind of the high end of the trading range that we could go to. You look at December corn, it's like 365. The low end, when you look at where The support is, it's at the bottom where you think the market could trade to. And we're sitting up in the somewhat trading ranges, and the market seems to be bouncing between those. But it's basically what you think the market's going to trade through. You trade through those areas, and that's when you start looking at the change in the trend and what this market's going to do. Two closes above a certain level means that we're going to be looking at this market possibly going a little bit higher. Two closes below, you're looking at a little bit of a sell-off going into play. You have to caveat that with some of the news that's going on. Like now, tomorrow, we've got that report coming out. USDA is going to be coming out with their crop production estimate. Estimates right now are that there's not going to be much change in the numbers. We look at wheat stocks dropping a little bit. Corn stocks, I think, are increasing a little bit. And the expectation is that soybeans will only drop about 10, from 480 down to 470. Why beans are dropping 10 or 20 today off of that is hard to tell, because I think they're looking at something else coming into play there. So I'll talk about the report a little bit more later. But now, futures, and that's kind of what I've just talked about, is a little bit about the futures market and where there's a little bit of risk involved with that. And now the other side of it is using options. Options, basically, any questions first? Anybody? It's warm up here. I like using options a little bit more just because it takes a little bit more of the risk off of it. There's a time and a place to use each of the markets and in each of the tools that are available. Futures have their risk, but they have their spot as well. But now looking at options, it's basically, they're openly traded contracts that give you the right to either go long or short futures at a specific price in the time. They're just like futures, except there's premium involved. They're designed to be a little bit more of a proactive for volatile markets. They help take a little bit of the volatility out of it. Then you're not going to hit a home run with an option. It's a good way to protect some prices. It's a good way to lock in some potential profit, but you won't likely hit a home run with those. They're a very good way for hedgers to protect themselves if you're going to be worried about margin calls. And margin's a little bit tight. I can understand where options are going to be a little bit more to look at. It's limited risk, limited reward. That's the thing to remember with an option. We've actually had some very good success with buying puts and selling some calls for next year's production. We did that quite a bit for the 16 crop. I'm looking at doing it as far as 17 crop right now for soybeans right now as well, where we can come in and buy close to at the money soybean puts, sell a little bit out of the money soybean calls, and it's a good way to protect some of next year's crop. Corn, I haven't quite looked to see if there's anything with that. Yeah, Ron. Yeah. Yeah. And, well, I don't know. I know my brother's not going to look anyway, so he won't look on the internet. I can talk about him. He's a little bit on the cheap order, and he actually agreed to do one of these the other day. So, 30, I think we did it for like at about 32, 33 cents, and we were buying at the money November soybean puts, and we were selling like 1140 calls against it. So it didn't turn out to be too bad. Now, I'll have an example about that a little later, but how many guys would go short November 17 soybeans at $11.40? How many would sell your production at that? We all would, unless it hits 12, right? Then we'd worry about it. But that's what this is telling us, is that I'm willing to protect this $10 and I can't remember what November 17 is at right now, but I'm willing to protect this price. But if it goes to here, I will take a short futures position. And that's what we're telling the market. And it's limited risk to do that. So, I mean, it's got some merit to do it. The one thing that you look at is that 85% of your options are going to expire worthless. So you're timing is everything when you look at options. Most of them do expire worthless. That's why people like to sell them. I like to sell calls too. For guys that are sitting with soybeans in the bin, sell 1140 call against it. Help pay for your storage against the March. They're like 15 or 17 cents. Well, they were. They aren't now today. But that's a way to capture a little bit of carry in the market and also to put a little premium in your pocket. Now, again, you'll sell soybeans at 1140 if March goes to that, right? You'd be happy to sell that. Take a dollar basis off. You're looking at 1040 cash. Likelihood we won't get there, but it'll also give you an opportunity that you can take advantage of a potential basis improvement in beans by waiting until that March time frame. So, nice thing about options, there's no margin calls when you buy. Now, I got a preference that you have to buy a call or buy a put. There's no margin calls when you do that. The premium you pay is basically transferring of the risk. That's the risk you transfer. So, for the return of the premium, you basically have established the floor. Buying a put. Now, if you're looking at needing to buy feed for grains, you're buying call options. A lot of guys like to sell grain and buy calls. And that's re-ownership. There's a time to do that. There's a time not to. And that's something that we'll talk about timing and pricing here in a little bit. Two types of options, like I mentioned, puts. Puts are for protecting the bottom side of a market. Producers should buy puts. Hedgers, you guys, farmers should be looking at buying puts. You should primarily look at buying puts. Calls, that helps protect the upside of a market. I always think of it as put down, call up. It's an easy way to remember what they do and what their purpose is. Put option gives you the right, but not the obligation to go short a futures contract. Used to protect the downside. Now, what's the worst case that happens if you buy a put and the market goes up? You donated your money. Put's going to expire worthless. But hopefully, then the price has gone up enough and you're selling at a higher price. At least you've established that floor and you're looking at marketing at a higher price. Call option is just the opposite. When you buy one, gives you the upside of the market, gives you some opportunity in case this market wants to run a little higher. You know, last year buying calls in soybeans was a tremendous idea because of the market running up like it did. Even corn there for a while. So going the wrong way. Basically, it's used for people that need to buy the grain or who want to re-own it. If you have to sell, this is a year where a lot of guys, how many guys had to sell grain off the combine that you didn't expect that you had to sell because yields were too big? You didn't have room to store. This is the time frame where you could be looking at buying some calls and having some ownership. Because, you know, you're forced to sell a little bit ahead and you want to use the seasonals to help improve that price a little bit. And there are some strategies out there for that, to be able to do that. But one thing, the things that you need for options, you have to have the futures market. So corn has an option, soybeans have options, each of the wheats have their options. Strike price, that's basically the level that you want to buy at. And that's probably the most critical, is picking the right strike price in the market, you know, as far as whether they're going to expire worthless or not. And that can be the tricky part. And then premium, of course, that's the amount that you have to pay for the option. Option buyers are the ones who pay the premium, and then you have no more exposure in the market. If you're an option seller, you actually collect that premium, and you do have exposure. You do have some potential margin risk with when you're the seller of an option. Oh, okay. Now, when you look at the premium, you have two different aspects of what makes up the premium. One's intrinsic value, the other is time value. Intrinsic is real value, something that's tangible, something that's real. Time value basically is the potential of the market getting there, or the potential of the having value. This is pretty complicated when you look at it, but when you look at intrinsic value and time value, that gives you the total value. Intrinsic is when there is actually value from the underlying futures. You need to be in the money. That's the term that we use. Time basically is the risk, you know, the potential of the market getting to your level so that your option will be worth something. The farther out in time you have, or the longer, buying a July call right now is going to have a lot more time value than buying a January call option. Just because there's a lot more opportunity for July to amount to something than there is for January. And that's what you look at as far as the time value is concerned. When you look at it, a strike price for a put, using January futures right now, they were trading at $10.50 yesterday. A January $11 put was trading at 65 cents. This is yesterday's prices. Your intrinsic value is 50 cents. Easy way to come up with that is futures are at $10.50. You bought an $11 put, you actually have 50 cents. Difference between where you have the right to go short at $10.50, the market is at, or you have the right to go short at $11, the market's at $10.50. You have 50 cents of real value in that, right? So we're looking at this trading at 65 cents yesterday. Your time value is 15 cents. When you look at it as far as calls, $10 calls yesterday, we're trading at 74 cents. So again, you're using the same type of math. Your intrinsic value on your call is 50 cents. Your time value is 24. So why are calls time value more? Basically for the same, basically the same position. Why are the calls a little bit more than what the puts are? A lot more speculation in calls. A lot more people trade calls than they do puts. And that increases the volatility, and that speculation increases the value a little bit. When you look at it at the money ones, you'll always pay a little bit more for calls than what you're going to pay for puts. When you look at the terms, in the money basically is options that have value. Option prices increases, and better you can collect the premium. But it's basically, when you look at in the money, it's ones that have value. At the money is when you're actually looking at buying futures and options are equal to each other. When I look at buying options, I try to get to close to at the money as I can when we're buying puts or buying calls, because you get a quicker return if the market stays in your favor. It's the futures change and the option change are going to be closer together than if you go out of the money. It takes a little longer. You have a little more of a lag price, lag time as far as the options being able to catch up. When you get at the money ones, at the expiration, of course, they're going to expire worthless. But when you look at buying them, I like to get to as close to at the money as I can. Out of the money, I like to sell calls that are out of the money. I don't like to really buy puts that are out of the money, but when you look at doing that, it's basically the futures and the call and the strike price are a little bit different from each other. For puts, futures are higher, and for calls, it's going to be a little bit lower. At expiration, of course, out of the money ones, you don't do anything with because they expire worthless. But when you're looking at selling calls, you want to get as far out of the money as you can to have that, to get enough of a premium, but yet to be able to have opportunity. So I normally don't like to sell call options less than 10 cents because of the risk that's involved. So there's a little bit of an opportunity to be able to buy, and at least you get a little bit of a return for it. So time value, I already told you, it's basically influenced by time to expiration, volatility of the market, and then what the classification is. Interest rates have a very small part as far as all this goes. One of the interesting things is that interest rates are going to become a little bit more of a issue here going forward. It's likely we're going to see interest rates start to increase. Is what we're kind of hearing from the Fed. So time value, there's a lot of things that can go in to affect the time value, and one of them is the expectation of what the market's going to do. Right now, soybeans have a little bit more volatility in them, and that's helping to support them and their options a little more than what you're seeing in corn. Corn is in a very tight trading range. Corn has been lucky to trade, other than, was it Monday when we were up 12 cents? It's been tough for corn to trade outside of a 3 to 4 cent trading range in the last couple of months, because there's just not a lot of activity in corn right now. Soybeans have been seen a little bit more. Now, when I talked a little bit, a little while ago about the influence between what futures does and what option strike prices do, that's when we tie into what's called delta. I'm not going to get too much into the Greeks as far as what, for options, there's a bunch of them, but the most important one is what we call delta. And that is any move in the futures, it's the corresponding move that happens in the premium with the option. Traditionally, when you look at the money options, you look at the correlation or the delta to be close to a 0.5 to a 0.6. That means that a 10-cent move in the futures will be a 5 to a 6 cent move in the option price. When you get out of the money, you start looking at deltas that are like at a 0.3. You get 10 cents out of the money, the delta of a 0.3 means that a 10-cent move in the futures will only give you a 3-cent move in that option. That's where it gets to be important when you start looking at it as far as options are concerned, which ones you're going to buy for protection, which ones you want to sell. It's important to watch that delta in those. And that's one of the things that we do is we try to buy ones that are close so that they move faster for the ones that we want to buy and ones that move slower for the ones that we want to sell. I just kind of went through that. Makes 10 cent with a 0.3 delta. So when you look at options, options get to be a little bit complicated. How many guys have traded options before? I think most of you have. So they're complicated because you have puts and you have calls and you can buy and you can sell both of them. So you know, a lot of guys get confused when you're buying a call, do you sell a put? No, you don't. You have to do the exact opposite of what you've bought. So there's 3 things that you can do once you've bought an option. And let it expire. If there's no value, we're basically going to let it expire and go worthless because there's no incentive to try to get out of them. Usually if there's enough of a value that returns money to the producer, then we will liquidate. But if there's no value there, we let them expire and go to the wayside. You can exercise them. The only way you're going to exercise an option is if you're deep in the money. Because once you exercise, now you're going to the futures market, you're holding that position, and now you're subject to margin calls. So if you're not deep in the money, you're likely going to wind up making margin calls right away. And then the other thing is to offset. Basically do the opposite. If you bought a call, you sell a call. If you've sold the call, you want to buy the call. So you just do the exact opposite of what you did at the same level that you did it at. So one thing to talk a little bit about futures that I forgot, and that is kind of when you go into expiration. When the contract's coming to the end of its trading, right now, well, Decembers are just about to go off the board right now, I think in another week. There's 2 things that happen once futures go into delivery. Delivery actually happens beginning of the month. You guys that have had cash contracts and had selling with the elevator have always got that phone call about a week before your contract, or the week before. If you got a December contract, the end of November, you get a phone call saying, by the way, you've got this contract, you need to do something with it. You need to either look at rolling or we need to make cash, right? The purpose of that is because when those futures contracts go into delivery, once December rolls around, there's no limits on the December contracts anymore. Or when they're in delivery, they take the limits off. Most elevators don't want to assume that risk. So they want to know what your intentions are. Once you go into delivery, there gets to be a lot more expenses as well. We've had some guys that have gone through the delivery process, actually in their hedge account, and it can get to be somewhat expensive because what happens is once you take delivery, if you're not willing to haul grain down to Minneapolis or Toledo or St. Louis or wherever the delivery point is, then you have to buy in a warehouse. So once you've taken delivery, either you retender or once you take delivery, it comes into your account and your account gets debited for how many ever bushels you've taken delivery for. So if you're sold 10,000 bushels of corn at $3.50, that's what, $35,000? Your account gets debited to $35,000. And if you don't retender right away, then you have to make that good at some certain point. So was it 1% of the futures contracts that are traded, they virtually go into delivery. 99% of them get offset because most don't want to go through the delivery process. It's not like it used to be where you could haul your grain down to Minneapolis and deliver it against the futures contract. You actually have to have it in approved warehouses, and they've tightened it up the rules a lot, so you can't. We actually did it once where we actually took grain down and delivered against futures contracts, and you can't do it anymore. It's a lot harder. So once you go in to deliver, you want to liquidate those positions instead of take the risk and look at rolling ahead. Same thing with options. You don't, when you're in the option, you don't have a lot of time to be able to switch out once you go into futures to switch out to. So it's better to either offset or look at let them expire. Some option strategies for hedgers: you want to buy puts or sell calls. Buying puts protects you. I mean, that's a limited risk and it protects your downside. Selling calls gives you a little bit of a risk, but it gives you an opportunity to sell at a higher price if the market gets there. Basically, selling covered calls is what we call it. Combination of both. That's the position I was talking about a little while ago. I like doing those just because it helps offset the cost of buying the put, which can be somewhat expensive. That's the problem with buying options, is that those premiums can be somewhat expensive, especially if you look at going far out in time. I mean, buying an option for soybeans at 67 cents can get to be pretty expensive. That's why selling a call can help offset it. So looking at options, I mean, options are a good tool to use. They have their purpose, they have their time, and when to use them. And that's one thing to look at. They're similar to insurance. You basically pay a premium. And hopefully the return is to be able to give you a little bit of peace of mind, at least some protective against adverse price. Locks in a floor and helps you transfer your risk. So the only thing you've got left when you look at doing, whether it's futures or options, is basis risk. That's the risk that you retain when you're doing futures and options. Now, well, I'll get into that here in a little bit. What time are we at? 11:20. When are they looking at food? Noon? That means I got 40 minutes. Okay. Yeah, I can do that. So, okay. Now, looking at, when you're looking at trying to get your best price, looking at selling grain, you want to look at trying to look at different marketing tools. And some of them that I like looking at are without watching. Seasonals, basis, the spreads. That's where I talked a little bit about earlier. Quality differentials, that's a big thing that plays more in wheat. Corn and soybeans, you really don't see much as far as quality is concerned, but wheat is a big one as far as quality. And then looking at developing a basic marketing plan. Now, seasonals work most of the time. 70% of the time, seasonals work. And that's something we should respect. We haven't seen them work the last couple of years, mainly because of some phenomenal things that have happened, whether it be drought, whether it be strong demand. Last year, seasonals worked fairly well. We were able to see them actually, normally in the spring, you see the markets peak out and trade at their best. And then once you get into this early summer, you start to see the market drop off. A lot of guys were a little bit hesitant here last year to price a lot ahead. Because when we were going into June and July, we were somewhat on the dry side. It held a lot of people back from wanting to do a lot of pricing. We have to look outside our borders, because look at what happened. Well, once the rain started, we started to see some pretty good potential. And we looked at a corn belt that actually did fairly well. So seasonals do work. Last year was a perfect example of how they do work. When you look at the chart, this is for corn for the 10 years. It actually shows that April is where we normally peak our prices. December, we get to see a little bit of a spike. Usually the first week of April is when corn prices peak. Now, this year we actually saw it because of soybeans running up. We actually saw the corn market peak in June, second week of June. June 19th to be exact. Looking at it for soybeans, it's a little bit later. You start to see the market peak traditionally over a long period of time in June. This year it was a little bit later than that by the time we peaked those. And you actually see a little bit of a spike. These are kind of how we want to look at when we're looking at marketing and how we're looking at selling overrun. The time frames that we want to look at as marketing, looking at locking in prices, because those are when the prices should be their best, whether it be for cash or whether it be for futures or whether it be for basis. And we want to look at doing a lot of component prices. The last couple of years have been years where we haven't been able to get, the market hasn't really given us a good opportunity, where we've had to nickel and dime the market a little bit more. We've had to use other tools to help be able to get to the price that we want for our product. Looking at locking in futures and basis at different times is a good way to do that. Taking advantage of basis when it's strong and taking advantage of futures when it's strong are two of the things that we look at doing. Now, remember I said that your local cash price is the futures minus the basis. Basis is pretty important. Basis is what your elevator charges you, and can be positive or negative. Most of the time it's negative up here. We have seen it a few times be a little on the positive side. Wheat is one that can go positive. Beans are likely never to go positive. Never's a strong word, I know. Corn has gone positive at times. Now, in the good old days, basis used to be stable and predictable, which means basis didn't change a lot. I mean, it was fairly constant. I mean, it would vary a little bit from harvest to spring, but for the most part, it didn't have a lot of change. Right now, basis will move 20 cents in a matter of a couple months. On average, when you look at good basis levels for wheat, you should be looking at a -20 for spring wheat, maybe a -30 to a 0, depending on the time frame. Once you get to December to May, we should be looking at 0 to positive. For corn, traditionally, we should be looking at a 40 to 50 under basis for corn. What's your basis level at most locations now? 65, 75, 85? I've heard $1.05 in places. Anything over 50, well, anything over 65 cents on a basis, they're basically telling you we don't want it. You know, take it home, try to find a place to put it, is what's happening. For soybeans, because of the increase in production over the last few years, an average soybean basis should be somewhere between a 65 to a 75 under. It used to be 50 under, used to be a basis that we could look at for soybeans. Not so much now because of the increase in production. You guys know where basically where North Dakota is for soybean production as far as the U.S. is concerned? What number we are in production for soybeans? Dave knows. We're 4th in the United States for soybean production. That means there's only 3 states above us. And I don't know which ones they are, but I'm assuming it's going to be Iowa, Illinois, and I don't know who the third is. Which one? Minnesota? So, you know where we are for corn? A little high. 11. We're 11th in corn production in the United States.
What were we 5 years ago?
5 years ago for soybeans, we were down in like 12 and 12, 13. And for corn, we were down at like about 18. So we've moved up pretty good in those. Yield helped quite a bit this year. I mean, this was our largest yield we've ever seen in North Dakota. Before was like a 134, 135, somewhere in that area. This year they're projecting it at 155. So yield helped quite a bit, but it goes to show you just where our acres are going. I mean, we're leaning more away from wheat and a lot more towards corn and soybeans. What does that mean for your basis? It means your basis is going to get worse. You know, at harvest time, basis are going to be wider. It's going to be a little slower to respond once you get past a little bit past harvest and once you go into the early parts of winter. And when you guys are your busiest and you don't want to haul, that's when basis levels are going to be at their best or potentially at their best. So what basically goes in and drives basis? Storage. Insurance and interest, pretty small portion of it. Transportation, local supply and demand is your biggest contributing factor to what happens to your basis. traditionally, when I don't like to do cash contracts right away. I mean, if you're looking at doing 17 sales right now, I wouldn't recommend doing basis at this time, mainly because right now most elevators are going to be having basis levels at a fairly wide level. One, they don't know what their transportation is going to be, trains getting in and out, what the costs are going to be. So they likely are going to pad their basis a little bit at this point because of unknown costs. So for the most part, this far out, we would only recommend doing future fixed contracts. If you looked at basis levels, though, that could come in that were better than your 5-year average, it might be worth taking advantage of locking a cash price in, mainly because most elevators are going to charge you a little bit to do just a future fixed contract. For corn and for soybeans, you can wait a little bit. You wait to see basically how production is going to come as far as your region is. June is a good time to be looking at, if you've done future fixed contracts, June's the time to be looking to see about where basis is at for anything that you've done, to look at locking those levels in. As far as soybeans, you would wait till about July or August. And the idea is then you've got an idea to see if you're looking at a big crop potential coming or if there's a little bit less of a crop coming. Elevators will tighten those bases up if they can't get the product when they need it. And that's important to watch. Being friends with the manager doesn't hurt either in case they have a train coming in. I actually had a customer call this week from western North Dakota. He's got a bunch of wheat. He's got like 400,000 bushels of wheat he's got to market. He hasn't really sold wheat the last couple of years. So he's sitting on close to 400,000 bushels. He's pretty good friends with the elevator manager. And the manager called him, and I've been actually trying to help him to try to get trains together to be able to sell his wheat by taking train cars down to Minneapolis. And he approached the elevator manager, his local manager, and said, I've got this many bushels. If you can shoot me some deals on trains, I would be willing to fill a full train of wheat. It's about 400,000 bushels. Oddly enough, that manager actually was able to sell, and kind of amazing, he actually himself sold wheat to Bangladesh. So this wheat needs to be loaded up and shipped out of his area. Two of his customers approached him about doing train loads, being able to ship a full train. They called up our customer and said, I'll give you an opportunity to put half of this train load together if you want to sell your wheat. Those 200,000 bushels he was able to move on this train. So we looked at the potential of that, and it actually made sense for him to move that. The elevator was giving him about a 15-cent better price than what his board was, just because they were able to get all the bushels from one location and get it hauled in. Paid off for him. The manager knew that he was willing to do this, and he was able to put it together. So now he's got to move 200,000 bushels of wheat to the elevator so that they can get this sale done. But so things like that are things you need to watch. The other nice part about it is that, we're seeing a lot more competition from elevators because there's a lot more shuttle trains that are coming into play, a lot more being built, and we're getting a lot more end users closer, whether it be for ethanol, whether it be for crush plants. We're getting a lot more local demand, which is going to help be able to chew through some of our bushels. Now, don't expect an ethanol plant that's close to drive your market. They're only going to bid aggressively. Well, they need product once they get it. They could get to be even the worst market at some point. You've probably seen that in Hankinson, the ethanol plant. When they need the product, they're going to bid aggressively to get it. Once they've got it, they're going to pull back. They might be about a nickel or 10 cents better than any local, but they're not going to drive a market. They're only going to drive it when they need the product. The storm is going to help bring the need to bring some product to town, likely. So strong basis, narrow is the more positive, kind of a bad term, but that benefits farmers. So you want to look at a positive basis, a tight one. As far as elevators, end users, they want to try to buy on a wide basis. Elevators love it at harvest time because they can buy a lot of grain with a wide basis, store it for a little while, and sell it into a better basis. They protect themselves as far as the futures are concerned, so they don't care what the futures market's doing. They buy and sell grain only on basis levels. What it costs them to bring it in and what it costs them to get transportation and ship it to the next destination. That's all they care about. So futures contract spreads, that's important to watch, to pick where you want to sell at. And that's one of the things out to May or July. What other things should we be looking at? We should also look at basis improvement, because May is not a bad time to be looking at selling product, especially old crop. Most of the time you guys are busy, you're in the field, you're doing things. If the ethanol plant needs, or if somebody needs to ship some, or has a purchase for corn, or a train show up in an elevator, it's not likely they're going to have a lot of corn sitting in that elevator to fill those needs. So they're going to be coming, and their basis levels are going to be a little bit tighter. One thing I'm concerned with, last year I was concerned with it, this year I'm concerned with it. There's a lot of corn that's stored out in the country right now. And there's a lot of it that's in bags, and there's a lot of it that's in piles, there's a lot of it that's in bins. The first stuff that's going to get cleaned up is going to be the piles. Likely most of them are going to be done and moved through by the time we get to January, February is what I would expect. So basis really isn't going to see much of an improvement up until that point. A lot of elevators have piles. It's going to keep it somewhat stagnant. A lot of those bags are going to try to be cleaned up before it thaws, especially if they're out in fields. So that's another thing that we're going to have to watch to see when, as far as when a lot of those start to come to town. A lot of producers like to hold corn until July. You know, if it's in your bin, you want to hold it till July, because then you're a little bit for your time. A lot of corn seems to want to come to market around that time frame. Look at locking basis levels in a little bit ahead of that, as far as corn is concerned. Traditionally, you look at July is a better time to do it. Look at end of May, early June, to at least lock basis levels in, because it'll widen out as you get closer to that supply ready to come to town. Last year I was concerned with it. This year I'm a little more concerned because of our yields. So for soybeans, for soybeans that are in the bin, hopefully nobody has any soybeans piled. But for soybeans that are in the bin, what happens in March timeframe? Traditionally, you start to see South America harvest kick up, and you start to see a little bit. We lose our exports basically to South America at that time frame, whether it be Brazil or whether it be Argentina. So normally our basis starts to widen out a little bit, and we don't have as much of an incentive to move product. By the time you get to February, it's not a bad time to be looking at having the basis locked as far as old crop soybeans. If you get an opportunity to get better than your 5-year average, take advantage of it. Look at doing either locking the basis or doing cash. Right now I think there's enough of a carry and enough of an incentive, to look at locking in that March futures against soybeans and wait for that basis level to come to you. If we can get closer to a 5-year average basis, and we can get it down to even 75 cents, you know, we're not looking at much below $10 cash price. Then we'd be looking at, what would that be, $9.75, somewhere between $9.50 and $9.75 cash would be potential. So to me, I think we've kind of run our course as far as futures are concerned for our front months. As far as beans, I'm a little more bearish to the bean market than I am any of the others. I think we have potential in corn. I'm kind of dragging my feet as far as corn sales are concerned, because I think there is potential for corn to see, especially with an acres decrease that we could be looking at next year. And I think once the corn's in the bin, it's going to be a little tougher to get it out. But look at the spreads, and if it's paying you to store, you want to take advantage of that storage. Now, wheat is not paying you to store. So if you've got wheat, it might be, you might want to start looking at locking futures in, and again, wait for that basis to come to you. Minneapolis is, When you look at the spread between Minneapolis and Kansas City and Chicago wheat, those contract spreads are way out of whack. And it's because we had a big winter wheat crop, but we had a low quality winter wheat crop. We had a low quality winter wheat crop coming out of the European Union. And all that has brought in that incentive to buy spring wheat. Canada's crop, they actually surprisingly came with their production yesterday or Wednesday, one of these days this week. Canada estimated their production higher than last year. They said their yield was pretty good, but they were looking at about a 6% less harvested acres. And 20% of the crop is still left out in the field in Alberta and Saskatchewan. But the expectation of the Canadian farmer is that they're going to go out there and get that wheat harvested. How many guys want to go combine wheat in the snow? I mean, think of what we've had for weather. They've had it too. I would be a betting man to say that wheat's not going to get harvested. The 20% that's left. They also have 20% of the canola left up in the field in parts of Saskatchewan and in Alberta. Likely that's not going to get harvested either. But yet, in the report yesterday, or whatever day Stats Canada came out with it, they said that the Canadian farmer is very confident that they will get the rest of the crop harvested. So they counted it as bushels. That'll come back to be friendly later, but just like USDA does, we'll see those adjustments probably 3 years down the road. Spring wheat has not, I think that market has kind of played itself out, and we'll start to see a little bit of a pullback, mainly because we've got too wide a spread between Kansas City and Chicago and Minneapolis. Normally you look at a 40-cent spread to Chicago and a 20-cent spread to Kansas City, and right now it's like $1. It's way too wide for way too long, and that's got to tighten up a little bit. Now, we actually started to see it a little bit when Kansas City started to get dry conditions, and we started to see some issues down there. But Kansas City's at lows again because they're starting to get rain, and the cold weather isn't looking like it's going to hurt right now. So, well, I've already talked about futures, so. Looking at the different ways. Now, you look at a cash market, there's different ways that we can actually price the grain. And there's different times and different tools that we want to use at the different time. This is a few of them that are out there as far as ways to price. One of them, you cash sale, cash forward contract, futures fixed or hedged to arrive. I'll talk about each one of these as we get into it. Basis fixed, I talked a little bit about that. Minimum price, delayed price. A lot of guys don't like delayed price contracts, but they have their purpose. They have their time frame. Of course, revenue insurance is another. It's not really pricing it, but it helps to give you a method. And then delayed price contracts or payment contracts and free storage. Oh, I didn't know I did that. Most of the time, you know, I'm always a little bit leery when elevator managers call and say, "Do I have a deal for you?" That usually makes me cringe a little bit, but sometimes they do have something that works decent. Their job is to buy grain. Just remember that. Your job is to sell grain. So now looking at some pricing methods and different ways to do it, and the timings that you should be looking at using these. One of them is pre-harvest. You know, that's when you want to look at doing forward contracts, minimum price contracts. Minimum price contract basically is like buying a put, selling the grain, buying a call to have it locked in. Future fixed contracts are also pre-harvest. Harvest, you want to look at doing cash sales. Minimum price contracts, again, that's selling cash. I mean, like this year, if you had too much production, you had to move it off the combine, buying a call option. Another one I wouldn't mind doing at harvest, which can work at some times, but not all times, and that is delayed price contracts. I'll get into those in a little bit. Post-harvest, basically you're looking at storing and then looking at delayed price contracts. And then I guess anytime during the marketing year, whenever you see futures at their optimum or at their best, that's when you want to take advantage of locking futures in. And then also when you're looking at basis levels being strong, take advantage of that. That you can do anytime during the growing season. This year was a good example of, once we started to see that we were looking at the potential of having a big corn crop. I had some growers call, and they actually had some pretty decent basis levels that were being offered to them at the elevator for early, for corn harvest, for harvest delivery. The elevator hadn't widened out their basis yet. They were able to lock in still up into September, 65-cent basis on corn, even 55 on some of it. I told them, if you know what you're going to have for overrun, look at locking in at least a third of that or half of that, because it's likely that basis level is going to widen out by the time you get into harvest. And if you know you have to deliver X amount of bushels in, lock the basis in on it. And it actually worked out pretty good. Pre-harvest, the trouble when you're going in is basically you're looking at planting. When you're looking at going, we like to use an 18-month window when we look at marketing. And actually, it should have started already for next year's crop. And then we go through most of next year. There's a lot of things we don't know about next year. You got an idea of what you're going to plant for acres, but you don't know for sure what you're going to have. Yield is another thing. And that's where we like to go off the crop insurance side of things and use your yields, your APHs, and historical, what you're looking at planting. Market volatility is another thing that's kind of hard to pick once you're going this far out. We do know right now the USDA Outlook came out with their numbers. This is one of the first times I remember them actually coming this soon with their projections as far as what they think acres and production is going to be for 2017, for the 10-year average. Most of the time they release those numbers in February. They released them last month. At least gave us a hint of what they were thinking as far as production could be for the coming year. So we have an idea of what the ag economists, or at least the economists at USDA, is thinking for production. They're looking for corn acres to drop by about 4 million. Surprisingly enough, they're only saying soybean acres are going to go up. I think it was only like 750,000. And they're looking at wheat acres dropping about 3%, which should be about close to 1 million again. So the nice thing about doing things pre-harvest, you can take advantage of opportunities. Usually you start to see the uncertainty of a market usually comes into play in the spring. When you're going into planting, you don't know, weather is an issue, demand is an issue, but you have opportunity in the market, and it gives us a chance to take advantage of that. That's usually when we prefer doing future fixed contracts, because the expectation of the problem is going to be built in futures more than it's going to be built in anything else. And here again, if you're buying a 75% level, you've got 100 bushel APH on corn, and you're buying 75% coverage, you've got 75 bushels of corn you can market without risk, because your crop insurance is going to cover you for that. Now, if you wind up producing a 150 bushel crop, you've got 75 bushels, like Amy was showing earlier, that's over and above being protected. So that's something we have to work out as the season goes. And that's, more once you get into that June, July timeframe. But using the crop insurance and your guarantees are a good spot to start, at least price up to those levels. Cash sales are pretty simple. Everybody does cash sales. Basically, you're locking in both the futures, you're locking in basis, and you determine what your price is going to be. Your risk is basically done. The advantages of it is that you know what you're going to get. You're grabbing your money and running. There's no storage costs. You don't have to worry about quality, the grain in the bin. You can ship the product immediately, and you can get your cash. It's primarily the most used tool out there. Disadvantages of doing a cash sales, you give up potential upside of the market if there is one. And the biggest one for wheat is that you might be you would be forced to lock in scales, discounts, premiums and discounts at the time of delivery. So that's a big one as far as wheat is concerned. For corn and soybeans, we don't care so much about it at this point. So, whoops, wrong button. Cash forward contract, basically the same thing as a cash sale, except it's just a promise to deliver later in time. You could do a cash forward contract right now for next year's delivery, or you could do one for a March delivery. You're still locking in the futures, you're still locking in the basis, you're locking in scales at the time of delivery. Once you deliver it, that's when they'll get locked in. But you know what your cash price is going to be, and you know how many bushels you're going to deliver. The advantages, again, you transfer your futures risk, your price risk. You take advantage of a carry in the market if there is one. If you're looking at selling in futures or in like in the March or a May, you can defer the income. That's always nice, especially when you're getting for tax planning towards the end of the year. Storage costs aren't there. You basically, if you've got it stored at home. But again, disadvantage is the same. You give up potential increase in price. No payment until you deliver, and scales are open until the time of delivery. For wheat, that again can be pretty big, especially if protein premiums start to widen out or there's an issue there. Hedge to arrive. These are the ones that we like to use the most. You hear a lot of talk about future fixed contracts. Hedge to arrive. They can get a bad rap. Basically what you do is you lock the futures in. You do not lock basis in. So your cash price isn't established as of yet. You basically are promising to deliver X amount of bushels of a product on this date or this time frame to the elevator. You eliminate your price potential because you take probably the one that has the most risk equation out, which is the future side. But you still retain the basis risk, which shouldn't be too bad. One thing I like to tell guys when you're doing future fixed contracts, at least have the right to roll the contract once in your contract. A lot of elevators won't give you the right to roll. And part of the trouble is that for guys back in the 90s, there was a lot of abuse to future fixed contracts, especially down in southern Minnesota. A lot of contracts were rolled numerous times. By the time the guys delivered the corn, they actually owed the elevator money. That's why it kind of got to be a bad name there for a little while. And they actually took the potential to roll out, but most will let you roll once. And that gives you an opportunity to extend your marketing period if you need to. Now, like I mentioned before, if you're looking at doing a December future fix, which is a good thing to do for corn, you want to use the harvest month because that's what's potential for downside. You lock in the December corn. If you're looking at rolling that ahead to July, you want to make sure there's enough carry to do it, that it pays for the storage and it pays for you to do it. But you want to make sure you don't have basis tied into this because they'll take the difference in the basis and add that on you as well. So I'll talk a little bit about the basis side of it in a minute, but advantages, you lock in futures when they're at the acceptable level or when they're at their best. Should take the riskiest part of the equation out of it, because futures should be the riskiest. You leave your basis open so you can take advantage of that at a better time. Seller does not have to guarantee quality. So for wheat, that's a nice thing because you're not telling you're going to deliver a certain amount. But if you can't, the nice thing about it is if you're doing it in the spring and March and you don't produce all the bushels, the nice thing about a future fixed contract is it's a line item in a ledger. It's basically the elevators locking that futures price in their hedge account. And if you can't deliver the bushels, it's easy to get out of that contract again. You can either have them lift the position or have it roll it ahead to next year. So there is a little bit more flexibility doing future fixed contracts than by doing basis fixed or cash contracts. And again, like I said, I want to make sure that we get to be able to roll it once. The nice thing about it is basically you're locking the futures in, but you don't have to pay the margin calls on the futures if the market moves against you. The elevator does that because they've got your grain as collateral. So that's how they are able to do it. Disadvantages, basis must be set at time delivery. So you have basis risk, which shouldn't be great, but there is the potential to have a little bit of basis move against you. So futures could go higher. Again, you might be able to sell at a higher price. There could be a service fee. Most of them that do future fixed contracts will charge a little bit, especially when you start looking at different crop years. For the most, elevators will charge between 3 to 5 cents for current crop year for 16. For 17, they might be between 5 to 10 cents. If you're looking at doing 18, they might be close to 20 cents. So be careful when you're looking at what they're charging as far as the elevator is concerned for a service fee. I usually tell guys anything more than 10 cents is a little bit high. You don't want to be spending more than 10 cents when you're looking at doing hedge to arrive. So the reason is, the farther out in time you go, why they charge more, there's more risk of them, for them to get those bushels from you because of, they don't know if you're going to be in business then. That's a vote of confidence, right? So best time to use hedge to arrive is usually when futures are relatively high. When you look at the seasonal movements of a market, spring is a big time to use future fixed contracts. And when your basis is weak, it gives you the opportunity to take advantage of the strong futures. Basis fixed contracts, basically what you're looking at there is locking in your basis, leaving futures open. You can, well, it eliminates your basis risk, which is not that big, but you retain most of the futures risk. Some of the advantages, if basis is strong, you can take advantage of it. It allows you to take the grain to the elevator, and it gives the elevator the right to ship that grain. So on a basis fixed contract, most of the time you will not pay your storage on it. So if you do a basis fixed contract, it lets the elevator ship it. You can receive an advance on that. Most of the time, most elevators will give you between 70 to 80% of the value of what the contract is. Because again, you've retained most of the risk. Be careful when if you do take an advance that you don't take too big of an advance so that the futures moves against you, you have to pay the elevator back. So that's one thing you want to pay attention to. Scales are usually set at the time of delivery. If you've delivered it, you lock the basis, the grain's in their hands, they are going to take advantage of the premiums and discounts at that time. So one nice thing about it is that you eliminate the potential of risk of having the grain in your bin. And if futures are a little bit on the low side, it gives you the opportunity to take advantage of the potential for the futures market to rally up a little bit. Best time to use these, which is absolutely the worst time for elevators that will never offer you this, is harvest. Basis is usually, well, basis is not very good, but futures usually isn't either. So you can't, it's very, very hard to roll basis fixed contracts because it's a cash contract. The elevator has, and remember what I said before, elevators buy and sell grain on basis, right? So they've locked your basis in, they've moved this on their basis, so they've actually got it locked in and it's moved, the grain is gone. It's really hard for them to want to roll that because they've actually shipped the grain and taken care of it. So if they are going to look at extending it or they look at rolling to the next contract, they're going to charge you the difference between the futures contracts. If there's a carry, you're going to get 10 cents less. Your basis is going to go up 10 cents. If it's an inverted market, then it actually is to your benefit. But very, very careful when you're doing basis fixed contracts. Most elevators like to treat those as cash sales, and they want the delivery at that time frame. So disadvantage, like I said, the basis and scales are set at the time. You have unlimited risk because you've taken pretty much the future side of it, which is the biggest side of it. Futures are left open. Full payment is not received until you lock in the futures, which you, again, be a little bit careful of that. There might be a small service fee with basis fixed contracts. There's usually not too much. But when you've got a strong basis is the time that you want to take advantage of doing these. So, and usually they're not being, they won't be offered at the time that you want to take advantage of them. So minimum price contracts, simply what they are is buying a put option is one. selling your cash, buying a call to cover them. There's a couple different methods of it. Basically, you've got futures locked, basis is locked, you've got your cash price set, but you've had some way that you've come back in again and had ownership of that grain. Most popular is to sell the cash and buy a call option. No. Minimum price on that is that you know what your cash price is. Whatever you paid for that option, you subtract off the cash, that's what you're going to get. Assume that you're not going to collect anything from the call option. Use that as your cash price, but it gives you an opportunity to keep the upside of the market open if the market was to run. Buying puts is another one. That's another minimum price contract. You still have an ability to get a higher price if the market rallies, but at least you've locked in that floor by buying the put. There can be a service fee with it, and then the added fee with the option premium that you might have to pay for. Elevators will do minimum price contracts for you. Most will. If you want to sell your cash and then buy calls, most of them will let you do that. Some don't, but there is an opportunity there. Advantages, you know what your price is. You know what your cash price is going to be. It's not going to change. Whatever futures does, I mean, the only thing you can do is get a little bit better price if futures increase, but if futures go down, you know what you're going to get. Basis and scales are set. They can be changed because you delivered the grain for the most part. Unless you buy a put, then of course, this is the call option side. If you buy the put, of course, then it's not. Full payment is on delivery. You know what you're going to get. You know what your money is. Futures rally, the call option will help increase your price. And it helps keep your upside of the market open. Now, disadvantages, basis and scales are set. So there's no advantage to take advantage of any improvement. Can be expensive depending on the call you buy. Remember, the closer to the money, the higher your premium is going to be. So that's something to watch as far as looking at when you do minimum price contracts. There could be another fee that gets added onto that the elevator charges if you do it through an elevator. And if the futures market doesn't do anything, like you said before, you contribute to the fund. The option will expire worthless, but you still locked in with a decent price. For put options, it gives you the chance to lock the floor, but if the market goes up, you have that opportunity. Put option side usually has to be done through a broker. Elevators won't do this. They will do the minimum price, but they won't do the put option side of it. Locks in a minimum futures price, but you have to pay that premium again. So you retain basis risk and, of course, quality risk with the grain. The nice thing is with the put option, we talked about this, you establish your floor. If the market goes up, you're going to get the higher price. You don't have to guarantee quality. And that's the nice thing about a put option is you don't have to guarantee the quality with it. Also, the other way is if you don't have the production, it's easier to get out of a put option. You just liquidate the option. So that's the other advantage to it is that you're not guaranteed to make delivery of the product if you don't have the product to deliver. The risk basically is the premium that you pay. So you're very limited on what your risk is going to be at this. Disadvantage, again, it depends on where you're buying those options at, but you could pay a pretty good premium as far as options are concerned. So best time to use is usually in the spring when futures are high and you're uncertain about your production. This year would have been a perfect year to have done puts because most guys weren't comfortable with where their production was going to be at because of the dry conditions we had in June. As it turned out, we had a pretty decent crop, but there was an opportunity to take advantage of some nice prices early that faded as the season went. So options actually worked fairly good this year. Delayed price contracts. A lot of people don't like these just because of what they entail. You delivered the grain to the elevator. You do not lock in futures. You do not lock in basis. You have no cash price established. But the elevator's got your grain. You give them the right to ship your grain. Now, sometimes, you give up all rights to it. So you can be careful with this because if you've done a delayed price contract at an elevator, one, make sure the elevator is solid because you become unsecured creditor to the elevator. If they go up bankrupt, you might not get paid for that grain because you've given them the title and ownership. One of the issues that we found with a lot of them that were doing delayed price contracts a few years ago is when the LDPs were in play. Once they did the delayed price with the elevator, it was no longer the producer's grain. So they were no longer eligible for LDPs if LDPs came into play. And there actually, a few years there, we did get to see that. Yeah. Well, when they went, the first time when they went under, there was a lot of delayed price contracts. There was a lot of contracts done. And when the elevator went, or when the ethanol plant went bankrupt, oh boy, that was a while ago, but it was a mess because here's the situation that happens when like the ethanol plant in the Hankinson, when it went bankrupt the first time. Not saying it's going to happen again, but the first time it happened, they had a lot of contracts that were out there, and they had the right, when they went to the court, they had the right to pick and choose contracts they wanted to honor and ones they didn't want to honor. Well, anything that was underwater, they wanted honored. They wanted to buy the cheaper grain because the market was above it. And anything that was higher than where the market was, they voided out. We had a lot of customers that had a lot of contracts voided because they had good contracts. We had guys that had 50% of their corn priced at the ethanol plant who wound up having zero price by the end of the year because they canceled all their contracts. In a delayed price contract, I believe they can still pull the grain in, but since you're an unsecured creditor, and now you want to make sure the bond is there to be able to pay, but that gets to be pretty sticky. There's a few other elevators, one up in central part of North Dakota that just went defunct here a couple years ago. They wound up having a lot of delayed price grain in there for a lot of their board members who didn't realize how bad the elevator was until they got the phone call too. And I had a customer there that was like 80,000 into the elevator for delayed price grain that he didn't get. So be careful of I mean, for the most part, most elevators are fairly solid, fairly good. You don't have to worry about it. But if you're doing a delayed price contract, be somewhat sure of what's happening and make sure that they're good, because you are an unsecured creditor and you give up the title to that grain. It's no longer your grain, it's theirs. So they have the right to ship it, and that's part of the problem too, is that the grain is gone. You can't go back and say, okay, I want my grain back, because it's gone. You basically have locked in nothing, everything's unpriced, and you just are basically waiting. They can, the day you deliver it, if there's an LDP, you can get it, but if there's an LDP that comes later, you're no longer eligible for it. Best time to use this is harvest. I mean, most of the time there is an advantage to using delayed price contracts because it gives you, if you don't have storage, you take it in, put on a delayed, it gives you some flexibility. Most elevators aren't going to offer it at that time frame because they're getting enough grain. They don't need to go out and bid for it. They don't need to try to offer anything special to get the grain. And sometimes they will charge for this. To do a delayed price contract, they will sometimes charge what would be equivalent to a storage fee. So that's another thing that you have to watch, is that you don't want to do a delayed price contract and have to pay a storage fee as well, because they are not holding that grain. Some of the advantages that you've got is that you're able to ship the grain immediately. So you can, if you've got storage issues or you've got grain that's not doing so well in the bin, you need to get room. It gives you the opportunity to at least move grain. It's easy to sell once you get it there. I mean, you know what's there, you know how many bushels you've got, you can sell it at any time. You eliminate most of your storage potential for storage problems for you. You can take advantage of improvements as far as futures or basis are concerned, because it gives you a little bit more marketing opportunity or time frame, and it also allows you to defer income. The disadvantages is the same as the advantages. You got unlimited risk in this because you've done nothing and you basically putting your faith in the elevator. Okay, and then looking at futures is another way to price the grain. We talked about that. If you want to, basically doing this future fix, except you carry the risk. And the nice thing about doing futures, if you do them in a hedge account, is that you're not tied to that elevator. There's a lot of guys that don't like to tie most of their production to one elevator on the expectation of basis, because you don't know who's going to offer the best basis or when. By doing it in a hedge account or futures, you have flexibility to go where you want with it. The other nice thing about futures is that we can do what's called exchange for physical. I don't have that up here, but what that amounts to is that you can actually take you let me know, I call you the elevator manager, and we can exchange your futures contracts that you have in your hedge account to the elevator for a cash contract. They basically will, so there's no slippage in the market basically. So we can do that with futures, and we've done it quite a bit over the last few years because of, that way you don't have to worry about getting out of one and getting into the other. It's just an exchange. The elevator sets the futures price, and we have the we have a cash contract then. So now I think we're going to have lunch pretty soon, but it's after 12. They coming soon? Okay. A simple basic marketing plan, if you do nothing else, just a simple way to look at doing a marketing, is to sell 1/3 of your new crop 4 to 5 months before harvest. So you basically would be looking at pricing or locking in prices sometime April, May timeframe, seasonal timeframe of a market when that's fairly strong. Don't plan to sell at harvest. That's usually when elevators aren't really offering good prices. Bases are its widest. If you're a livestock producer, that's when you should be looking at buying for the most part. If you need corn needs or soybean meal needs, harvest is the time to be buying the grain. And then as far as the cash side of things, look at marketing about 2/3, about 3 months after harvest. If you were just looking at a strict cash method of doing marketing, this is the route to look at. The reasoning is, you take a lot less risk by, if you market 1/3, you can be pretty much assured you're going to produce about 1/3 of a crop or whatever commodity you're raising. So by selling that ahead in the cash, you're not taking a lot of undue risk. And once you get harvest done, you know where your bushels are going to be at. You can market the rest at that point in time, at that time frame. There are somewhat unwritten guidelines of when you want to have X amount priced as far as looking at your growing season. And by the time you're getting in the field to start planting or start putting the crop in, you look at pricing about 1/3 of your crop by the time you're getting in the field. By the time you get to see June, July timeframe that your crop is growing and it's actually not looking too bad, that's when you can look at pricing about another 1/3. And then once you get after harvest is when you can actually look at pricing the last 1/3. So those are time frames when you're looking at what, you're going to produce about 1/3 to half of a crop for sure. Price that by the time you see that crop emerging, and by the time you get into the beginning of the good growing season, and then you have the rest that you can price after that. So. Yeah, I'm going to break while they bring in. Going faster than, oh. Yeah. It's going faster. Okay. Okay. So she knows what she got filled out and stuff. Okay.
She wants to put a meal down for you too.
Thank you.
Yep. Yeah.
Won't be too far off time. spot. It's not like there's a lot of people on it right now. I wouldn't think either. Can you do, oh, goal, yeah, year. Can you bring up? Yeah. No, bring up, yeah, yeah, like November. Yeah. It's a little faster. November. No, beans. Yeah, sure. Oh, I suppose because November wouldn't show up. Jesus, that's cool. Yeah.
November 17th.
Yep. Okay, that's January. Yep, that's January. Okay. Yep. Okay. I got about 5, and then we'll go over 5 slides, and then a couple charts. Okay. Should be pretty close. Yeah, it's actually.
Before they go home, where you start. I have some good.
No. You're too kind. A little bit, yeah, more, a little bit. Strategy, what a couple of things are, and then actually show charts. Talk a little bit more about current.
There you go.
So, but well, I'm going to get started up again. Just have a couple more slides to go through and then kind of pull up some, talk a little bit more about current things, but I don't know if it's a good thing that you've eaten or a bad thing that you've eaten, but I'll tell you what the markets are doing. So wheat actually is holding a little bit of strength, go figure why, you know, wheat's doing exactly the opposite of what everything else does on a day, but Chicago's up 5, Minneapolis is up a couple, and Kansas City's up a couple. Corn's down 5 3/4. Beans right now, down 21 1/2. So they haven't really gotten much worse since we started. I have a feeling the culprit is coming out of bean oil, which is down about 71 cents. So we're seeing a little bit of the products come under some pressure. The dollar continues to be very strong, which, you know, here's the struggle to try to figure out. Normally you talk about the inverse relationship between the dollar and crude oil. The dollar's up almost 9/10 of a cent. Crude's up $1.02. So normally you see the inverse, you know, when crude's higher, dollar's lower, and vice versa. But right now we've got them both trading a little bit on the higher side. So, and I remember, if I remember right, cattle were lower when we started this. So they are now higher. So because of the grains being a little bit softer, we saw the cattle markets come back a little bit. So, but kind of an interesting turn of events. Now, I've just got about 5 slides left, and then I'm actually going to go in and let's start looking at some charts and kind of show you support and resistance, and then also some strategies of what to look for or what to look at here as far as what you can do. But I'm assuming most guys would rather look at soybeans because that seems to be the market that everybody's the most interested in because of the acres potential. So looking at some simple strategies, I mean, you know, we're just kind of wrapping up a little bit with the options. Looking at buying a long option, you buy, you pay the premium, your risk is limited to the premium that you buy. And I'll talk about some of those strategies when we look at the chart. A short option, again, that's when you're going to look at selling an option. You're going to collect the premium, but you're going to have risk. And, you know, for grain that's in the bin, this is not a bad strategy to use. I like doing it just to add a little bit, to pay for a little bit of your storage and then to add a little premium onto the market, so, or into your price. A synthetic long position, it's basically you're looking at buying a out of the money call and then short out of the money put. A lot of guys talk about selling puts. For producers, I would tell you don't sell puts. Because when you're selling a put, you want to protect your downside in the market, right? Selling a put does the opposite. It's a wildly speculative position for a producer. And if you're buying a put and selling a put to try to cheapen it up, really what you're doing is you're saying to the market that at this level, I don't want any more protection to go down. So I wouldn't recommend doing that. For producers, I have a really hard time justifying selling put options. I like selling calls. I don't like selling puts. A synthetic short position basically is looking at an out of the money put and then selling an out of the money call. Those are strategies I like doing. That one I actually like producers doing that, especially in soybeans and corn for protect, you know, especially for 17. That's a strategy to be looking at. So. I lost this. I think we lost the computer. We have a technical difficulty right now. Yeah. Don't. Oh, that's ABG. Okay. There we go. It really wanted you to safeguard. It's just ABG popped up for some pop-up, so I think we get those closed, we'll be all right. Mm-hmm. Oh. Well, Amy works on that. I'll talk a little bit more about current things that are going on right now when we look at the markets and what we kind of expect. So then we'll pull up, if we can get this to work, then we'll pull up actually some soybean charts and take a look at some things there. But right now, the expectation is, as far as the markets are concerned, is that we're going to see less corn acres next year. We know yields are going to be pulled back because trendline yields are going to come into play when we start looking at numbers as far as USDA is. And that is going to lower production by about 5 to 6 to 7 bushels in corn. And it's likely to lower it about 5 in soybeans. Soybean acres, as I mentioned earlier, are only expected to be up about at 750,000. And I think that's a little bit light for the numbers. I think what we're going to look at is more of about a 5 million decrease in corn and a 5 to 6 million increase as far as soybeans are concerned. Now, how are we going to prepare ourselves for looking at that much bigger of a production for soybeans? Because it's not that we're going to see that much bigger of a production number than this year, because when you lower the yield, that's going to bring down production quite a bit. But we're still going to be looking at a potential of having quite a bit added to our ending stocks estimate. Soybean exports have been extremely strong, and right now we're sitting at about 77% of what USDA's expectations are. And we're only about 3 months into the marketing year, which tells us that it's likely USDA is going to increase exports for soybeans in the report. All likelihood, what we're looking at is, and also one of the things that we saw is that day before Thanksgiving, EPA came out and surprised us by increasing the mandate or increasing the amount of soybean oil going into biodiesel. It went from 2 billion gallons down to 2.2 billion. So the likelihood of that is that we're going to be looking at more of a crush potential for soybeans. So now crush demand is going to be up a little bit. In essence, it's likely we have closer to a 380 million bushel ending stocks for soybeans for 2016. Projections right now is 480. It's likely we have closer to 380 because of the extra demand that we're going to see from these two sources. Now, does 380 million bushels ending stocks estimate justify soybeans trading at the price that they're at? No, it doesn't. The expectation that we could see some production problems in South America and Argentina helping to give this market a little bit of push, yeah, you could see that this volatility and the concern is what's helping to keep this market a little bit strong. But it's not enough to hold this market where it's at. Now, add on top of that another 4 billion bushels ending stocks estimate, and using the average yields, we could see stocks increase a little bit for next year. Thank you. So for the price to be able to hold up where it's at for soybeans right now, doesn't look like it's a long-term potential. It looks like right now we're looking at more at the concerns of short-term needs and short-term support keeping this thing a little bit strong. Last year, what we saw was why soybeans rallied as much as they did was because of the meal problem that we saw coming out of Argentina, or the potential for that. Right now, we do not have a soybean meal problem. because of the soybeans that we produced in the U.S., because of the soybeans produced in South America with Argentina and Brazil, and because of the strong corn production in the U.S. and the strong ethanol production, we have a lot of DDGs. DDGs and soybean meal are somewhat, they're competitors, so they're competing products. There's not going to be a meal issue this year or a protein issue as far as feed is concerned. So right now we need to depend more on the soybean oil helping us to drive this market than anything else. There are a couple things to watch as far as world vegetable oil product production is concerned. Palm oil is having some issues as far as Malaysia is concerned. So their palm oil is down a little bit for their production. You're looking at Canada having a little less production as far as canola. We're not going to see that for a while, but the reality is going to come into play at some point. Europe last spring had a canola rapeseed production issue because of their wet conditions. So the demand for world vegetable oil is very, very strong right now because of the issues as far as supply in a lot of other areas. We're not seeing it in sunflowers. We're seeing it more in canola prices, and we're seeing it in the soybeans. And the soybean oil market is holding up fairly well. So that's been our caveat that's been able to help hold this market strong. At some point, though, that is going to run its course, and it's going to start to fade. So with that, I'm a little more bearish to beans, but beans are a very good market to keep us very humble, which we've seen over the last couple of months. So it seems like we can get up into this range that we're in, which is in this 1050 to 1060 area. And, you know, we go up and touch it, and then we pull back down. The likelihood of us breaking right now below a $10 level is pretty hard. If we break below that, we're going to be in a little bit of trouble. But I don't think the market's got the capabilities to do that until we start seeing combines rolling in Brazil and we see where those yields are, and we start to see some demand slip away from us. We get the price up this high, which has been interesting. When we saw just before Thanksgiving, when the market rallied, we've been seeing some pretty aggressive daily export sales numbers come in. And for about 12 days, we saw nothing. When soybeans rallied up and they were holding up in this level the last time, we saw no sales come into play. When the market dropped back down and we got down into the low 10s, we started to see some of those sales come into play. So right now, that tells us that China is very fickle on buying soybeans. They will buy them at a lower price. They are not going to buy them at a higher price. So as prices start to drift a little bit, there's going to be some opportunity for sale. There is opportunity to be pricing some soybeans and looking at doing for 17 crop. I think we priced 10% right now at about 10.15 futures, I think it was. At 10.45 is where I was looking at advancing sales again for soybeans. This is a market that I think I would rather be a little bit more aggressive on pricing soybeans, and then if I'm wrong, buy call options to protect, cover with calls or cover with something to help to have ownership again if this thing gets wild in spring. February is going to be important because everybody's memory is as good as last year, right? I mean, that's really what we tie everything to, is what happened last year, because we can't remember farther back. Everybody has got that in their minds of what happened in February and how this market rallied up because of that trouble in Argentina. And they're going to keep that in mind, and that's going to prevent this market from dropping too much until we get a little farther with production and start seeing yields come in to be from those countries. Right now, in the report tomorrow, it's likely USDA. I think that a 10 million bushel ending stocks decrease is too low or too high, too low. I think it's going to actually be coming lower than that. I think USDA will come in and they'll increase exports by at least 10. They'll increase crush by 5 to 10 million. So we should see a little bit more of a drop in the ending stocks estimate. The biggest number in tomorrow's report that you have to pay attention to isn't U.S. numbers. What is USDA going to do with Argentina, and what are they going to do with Brazil? Right now, Brazil is projecting a production of about 102 million metric ton, 103 million metric ton. Argentina is down from last year. I think last year they were at 56. They're looking at it being closer to a 52 to a 53. Not concerning because what happened last spring with Argentina? Now we go into the other part of things that drive markets, and that's governments. they elected a new president in Argentina. What was his campaign that he was going to do? Take away the export tax on wheat, corn, and soybeans. So most of the producers, most of the rural voted for him. What is Argentina's main source of income? Tax on exports of wheat, corn, and soybeans. So you take away your major funding for your country, what happens? You don't stay in power very long. Well, he did take the export tax away on wheat. He did take it away in corn. He left it in place for soybeans. So now if you're the average producer in Argentina and you're raising grain for the government, basically, because they do most of the marketing, if you know that you have no export tax on wheat or corn, but you do on soybeans, what are you going to raise? Because you're going to get more money by raising corn or wheat because they're not going to tax you. You're going to put more corn and wheat in, and you're going to plant less soybeans. So that's why the soybean acres are a little bit less in Argentina this year compared to what we've seen in the past. So, though, I mean, right now, Brazil is actually sitting very, very good as far as conditions are concerned. They're sitting with about 90%, 95% planted, and conditions are very good. We're about 46% planted in Argentina. We could still see some acres sway over. We'll see how that happens as it goes forward. But like I said, if they start combining early in January, like they think they could in Brazil, that will disrupt some of our exports as far as U.S. is concerned. And we could see our soybean, potentially see our soybean market start to fade a little bit sooner than normal. So, oh, it works. Okay. Another thing, looking at put options, like I said, they're like insurance. That's what we kind of compare them to. They provide revenue when the futures prices fall. They're just a good marketing tool to use just to help limit your potential in the market. Selling covered calls. What I like about those, you know, for grain, especially that's in the bin, you have the product. So really what you're telling the market is if you rally to this point, I'll sell you my grain at this point. If we don't, I'll take the call, I'll take the premium, I'll put it in my account. The biggest problem is with selling, just doing covered calls, is that's all you get is the premium. I mean, if the market doesn't go up there, you still got a lower price to market your grain at. So you still have to have another alternative plan as far as looking at selling the crop. Yeah, and it's hard to count it as a sale because you don't know if you're going to get up to those levels. So what I was looking at is basically as an example, July $4 corn calls were trading at about 13.5 cents. You sell that, you collect that 13.5 cents, it goes in your account. By the end of July, if the market is below $4, you get the 13.5 cents, and that's all you get. If the market goes above $4, you take a short futures position at $4. It's pretty simple, but you also have margin calls if it does that. So, bull call spreads. Right now, if you've marketed grain, had to sell grain ahead, I'm telling guys, consider doing bull call spreads right now in this market. I don't like doing it in soybeans right now because I think that market's a little high to be buying. I'd like to see a little bit of a retracement in soybeans to do it. Wheat, same thing. I think that market's a little high to be looking at doing it. And also, don't trade options in Minneapolis. They're just so thinly traded that it's tough to get anything done. It's better to go to Chicago or Kansas City. But for corn, there's a chance to be able to do bull call spreads right now. That market hasn't taken off as much, other than Monday where we saw the 12 cents. And really what doing a bull call spread is doing is telling you think the market's going to trade in this range. Whether it be, in my example, I've got buying a 380 July call for 21 cents, selling a 430 for 7. Basically what I'm telling the market is I think corn's going to trade above 380, but I don't think it's going to go above 430. In this case, I'm paying 14 cents for that. Net cost is about 14 cents. My opportunity is 36 cents. Basically, the difference between the two strike prices, well, that's what I pay for the option. So I could potentially add 36 cents onto my corn price by doing this trade. And for the most part, that's what you look at is about a 1/3, 2/3 return type thing when you look at corn. Spreads for corn, you look at basically you look at 50 cent spread. For soybeans, I like doing dollar spreads. Just because of the potential of the market. Now, best case scenario is the market rallies above 430. And what happens is that you're long the market at 430 because you have the obligation to do that. You'll go long or short at 380, they offset each other. That's why there's no risk in doing bull call spreads. There's no margin calls in doing bull call spreads. So there's other strategies here that I've got that it's in your packet. I'm not going to go over those because they're a little bit more in depth, and just to give you a little bit of reference for them and stuff. So, but that's what. Hit escape. Okay. Now, I think that's the January.
Yep, it's January.
Okay. This is January soybeans. Yes. Sure.
Okay, Randy, we always talk about soybean being priced at 23, 24 times. So it's way out of whack now, so does that typically kind of get closer together when we got buying intentions? Is that in that?
It can, but and that's a good. I'm glad you brought that up, Todd, because that's another thing that kind of strikes against soybeans right now, because in reality, soybeans are telling the market we want acres, and we're not encouraging you to plant corn because we're giving you more of an incentive to plant soybeans at this point. I don't think that in what Todd's talking about is the spread between corn and soybeans, the ratio between new crop December corn and new crop November soybeans traditionally runs at 2.4. So 2.4 times the price of corn is where soybeans should be traded at. If they're outside of that area, one's buying acres and the other one's losing acres. Right now, we're probably like a 2.8, 2.9, somewhere in that area. I know it got over 3 at one point. I think it was like 3.1 at one point, which extremely leads to soybeans. So right now, the market is telling us there's more of an incentive and more of a better return planting soybeans than there is to do corn. Now, if you want to be a contrarian, you plant corn. But the market is basically right now saying there's better returns as planting soybeans. I do not think that that is going to come back in line for a while, because a 2.4 billion bushel ending stocks estimate for corn is huge. It takes a little longer because we've got exports for corn are running at about 24% of expectations. Shipments are running at about 24% of expectations. Sales are running at about 50%. We're about, like I said, 3 months into the marketing year. Corn export sales are at best going to make pace with what USDA is projecting. Soybeans are extremely under what we're going to do. So the likelihood of corn seeing any more of an increase in demand is very limited. Feed demand is already at its peak. We already have ethanol at, because the Renewable Fuel Standard said it was going to be 15 billion gallons. I believe it was 15 billion gallons, which converts back to about that 5, or what we've got projected as far as the corn demand. So it's not likely we're going to see ethanol increase as far as demand for corn. We're not going to see feed demand increase for corn. It's likely we'll switch at this point and feed more wheat than we will corn because of the price differentials there. That tells us we have a lot better, kind of a long answer to a short question, but we have a better potential to see the demand improve for soybeans over corn, which will tell us that that spread won't change much until after we see planted acres for this year. So I do expect that we'll continue to see that spread can stay wide. Now, what could kind of disrupt it is if there's a lot bigger crop out of South America than we anticipate, which will then take some of the pressure off of us needing to have the acres increase. This is basically what January, right? January chart. So this is the front month. This is the old crop soybean front, the one that cash is based off right now. So we're looking at, we actually, we did a double top there. So that's the negative. There's one negative too. You actually see the market where it came up and kind of hit those two high levels and then backed off of it, those are now going to become what we call resistance, very strong resistance. Because if we go back up and touch it a third time, it's not going to hold. We're going to go higher. So that's one thing to pay attention to. This big drop right now takes us right back down to the low end of our trading range. Right now, this is what leaves me as confused as I can get, because when you're looking at being down, this is going to be the minor support. When you support, basically, like I said, it's battle lines. It's where you look at where a lot of things have taken place, where it's traded down to, and you can kind of draw a line from there all the way across and kind of see where it makes sense that that could be some support. If that report comes out bearish tomorrow, 2 closes below now where we're at today. Today's low, 2 closes below that tells me we're going to see this market go down, and we'll trade down to this level then. But if the report comes in and it's not a 10 million bushel cut in any stocks, it's a 30 million bushel cut in any stocks, it's likely we're going to come back up and try to test this. I'm being patient to try to do anything with beans right now just for that reason. If it is a little bit negative, we get back down here. Down here is probably where I would start then looking at doing those bull call spreads I was talking about. Re-own some of the beans that you sold earlier. Very unlikely we're going to come down and touch this level right now. I don't think the January contract has that in it. The January will expire before it has that opportunity. So for old crop right now, if you've got old crop beans in the bin, sit in your hands until tomorrow and see what the numbers say. We're in a bad spot, but that trading range is pretty well developed right now and where it's at. And right now, I would say it's, God, I wish I had better eyes. 1029, the low, yeah, right there. 1020, what's the high end of the range?
The high was 149.
Keep going up a little bit more. Right there. 1040. So 20-cent trading range just in this last few days. So 1020 to 1050, basically 30 cents. That's so. We break about, the report comes out decent. We'll see the market go back up again. So pull up to November. Anybody have questions? 11 o'clock. That doesn't mean I'm going to know at 11:01 what it says. So. Internet's great, but it isn't as fast as it, so
Like when I always talk, they preview the market in the morning.
Yeah.
Get that?
Yeah.
That's just guys just analyze,
Right.
There's no official numbers that come out from it.
Until 11 o'clock. Yeah. Nobody gets it. Actually, okay, I'll digress again. I actually had the privilege of being at the Statistical Service one time when they released numbers for a report. It was the March acreage intention report. And, you hear about the secrecy that they have in those numbers, and it's pretty, it's intimidating, actually. You go to the USDA building, you walk in, and you actually have to give a pass to go down into the area. And you go down into a bunker that's so old, I'm surprised that it's even functional. But, I mean, it's in a basement. There's no windows. Any windows that are there are blacked out. You go into a waiting room, because you're not allowed to go in yet, because we were just spectators. So we had to wait in what was called the bull room. We had to give up all our phones. All electronics had to be given up, and we had to check them at the counter. So we go into the room, we wait, and all the reporters are there. I mean, DTN is there, Reuters is there, Dow Jones. Everybody who wants to write about the report is sitting in this room, waiting for, well, they've got the report, because they've been able to write everything they want to write about the numbers. So they know what it is. They haven't told us yet, because we're just nobody. But they've had it, and they've had the right to write about the numbers, because there's no electronics in this building at this point. They've shut off all internet. They shut off all, because nothing can leave yet. At 8 o'clock, they flip the switch, 8 o'clock their time, and then they all send out the report at the same time. Back then, that's when the report came out at 7:30, I guess it was. So at 7:30, then they sent the report out, and then they briefed us, because then the Secretary of Ag comes in, and they brief him on what the report is, and then he says, "Yep, that's okay," and he has to actually physically sign the report before they can release it. So I actually got to sit in the room and At that time, the Secretary of Ag wasn't there. It was the chief economist that came in and signed off on the report and said that it could be released. And then we got to sit in the briefing that he was told about the numbers. But they do see it an hour before. Nobody can transmit it. And you're in a room that has staggered walls. So when you walk in, you take a step, you have to step to the side. You take a step and you have to, so then nobody can get hand signals to anybody outside of what the report said. So you walk through a zigzag through these walls to get in there. It wasn't quite like Trading Places. It wasn't Beaks and it wasn't a monkey. So, but yeah, and when they get it, when they actually get the report, a friend of mine actually had been he was the state statistician here in Fargo at the time. When I met him, he was actually the head of the statistical service in Washington, D.C. So that's how I got to go to the report. And he said they actually collect the information about 2 weeks before, and then there's different people get each state's, and it's encrypted, and nobody knows what states they got. And they just then go through the numbers and figure out statistically what it is. And nobody knows what it is at that point. They just know that they're going through a bunch of numbers. And then two guys come in the night before and then compile all the numbers for the report. But they're locked in, no communication, no nothing overnight going over the numbers. That was a long answer to it again, but okay, now for 17 beans, guys that wanted price 17 beans. If you ever have a chance to actually sit through one of them, it's actually kind of entertaining. When Keith Collins was the chief economist at the time, before he came in to talk to us, we were told, you do not talk to him, you do not say anything to him, you ignore him, you just sit and be quiet. Well, most didn't realize Keith is kind of a little bit of a funny guy. He came in and actually came right over to us and started talking to our group because we're from North Dakota, and that was the year that durum acres were dramatically higher. And he said, boy, this is a good report for North Dakota. And he actually sat and visited with us, and none of us wanted to talk because we didn't dare. And so it actually turned. Mm-hmm. Oh boy, it's government. There is, and that's why when they put together the numbers the night before, when they come in and look them over, they have the right to tweak as needed for states for certain circumstances. Because then those guys actually know the states, because when they're putting the final numbers together, they see it all comes to, so they can tweak at that point. Those guys have a lot of power. So I remember at the time, Informa, I'm really digressing here. Informa was, what was their name before? I can't remember before they became Informa. But anyway, they hired most of the statistical service statisticians to go to work for them so that they could compile the reports before the USDA came out with them. So they would have an upper hand on knowing what the numbers would be and they could trade it before it reported. Anyway, this report came out wildly different than what everybody anticipated. Nobody expected to see our acres jump like they did for what came out of it. And I remember we were having, Steve Wyatt was the guy's name. He was the head of the statistical service. We were having lunch with him after the report. And he got a phone call from the head of Informa wanting to have a meeting to see why USDA's numbers were so far off of theirs. So it was kind of entertaining, but anyway, looking at 17 beans ahead of what we need to look at as far as pricing for this next year. Like I said, we've done some pricing already. 10, 15 probably is right about where we're at right now. 10, 14, okay, we're at 10, 14. So right about now is where we're at. So you can see, again, that line is pretty defined. I think we priced right about here just before it spiked up. That was good timing. But you can see that's kind of where the battle line is drawn, is at 10, 14. We're at support again, just like we're seeing with the old crop. We're seeing it with the new crop. Again, if that report comes in a little bit different, we could see this market spike up again. But that's actually what we call well, it's an M formation, upside So we'll see if we break through that. Again, 2 closes below, we're going to see this market drift back down again. And it's likely at that point we could take new crop down into this level. That would be a pretty big push down, but we could see that. If the report comes out a little decent tomorrow, we could see it go back and try to test the high end of that, which at 10:45, I would be looking at selling again, selling some more beans. So. Exactly. And now the market is going to make a decision if it's going to, that's exactly why it did it. Yep. You know, it's not because we know anything more today than we knew yesterday about this report. I mean, the expectation is still there. Somebody's betting that. And exports actually came out, here's the kicker, export sales came out this morning at about 50 million bushels. So it was a good export sales number for soybeans again. So for it to pull back like that really wasn't expected. And that kind of feeds the frenzy a little bit. So use EVG again. So anybody want to see any other? Corn, wheat? Nobody cares about wheat anymore, do they?
I was looking at that actually early this morning, and I thought, like you mentioned earlier, that we're kind of following 2015 kind of thing. We have a spike up because of and then I kind of dropped after December. I was trying to find that chart. I couldn't find it. I recall it as last year. He did kind of thing, maybe a little earlier, and November she started going up.
Yeah. Traditionally, when you look at seasonal movements of a market again, traditionally soybeans will rally the week before Thanksgiving, and we saw that take place. And everybody kind of questioned why would they do that? Because our stocks and everything, so it was kind of hard to believe that we could see that kind of a push. But seasonally, you do see soybeans rally the week before Thanksgiving, and that's exactly what happened. Now, there are also the saying is that the bears get one holiday, the bears get the other. You know, so right now Christmas could be going towards the bear side, where the bulls got the Thanksgiving. So we'll see if that comes into play or not too. So. Oh. Any questions or?
What's the realistic number for old crop corn?
Old crop corn sitting in the bin? Are you patient? I'm actually looking for 365 against the December, which would be a 375 against the March. So, well, yeah, you know, that I can't help. You got to remember, the market's job is to find who can produce the crop for the least, and then not who, you know, so. I do expect basis levels, though, to improve. So I would be looking at, right now, for as far as a cash prices target is, I'm looking at something around the 325. So with that 375, 365, if we can hit it here in the short term, I would be looking at a 40 to a 50 under basis. If that helps. No. So. Any other questions? I know you guys got questions. Well, if you don't, you know, you can. I think your basis will improve as you go through summer. Here, you know, acres are going to be down, and if in minimum right now, I would be saying it's going to be 4 to 5 million bushels lower, or million acres less. So it's not that corn is going to see an extremely bullish picture as we go forward, but I think it's going to be an improving picture, so that I think you could hold corn and it will pay for the storage. And you could hold it, and, you know, high end of the range, we could maybe be looking at the possibility of a 350 cash at some point during the summer. Now, Do we want to wait for that? And that, you know, so that, I mean, that gets to be the questions, but I think that would probably be about as good as it's going to get for corn. Now, with that, even with a 4 to 5 million acre decrease and with yield decreasing a little bit, stocks are only expected to drop from a 2.4 billion down to a 2.2 billion. Now, that's a bunch of USDA economists who don't see sunlight that came up with these numbers. So take it for what it's worth. You know, I normally don't put a lot of stock in what the Ag Outlook numbers come in, is because they take what's happening today and just extrapolate it out 10 years. They don't look at what current events could be or what could actually be happening. So first couple of years of numbers, they can be fairly accurate or fairly on, but after that, I think you just can't project 10 years out. So, and right now their projection is that soybean price and corn price aren't going to change much over the next 10 years. Well, you tell me what weather is going to be next year or 3 years from now. That's going to be a bigger deciding factor of what happens.
Randy, if that Brazil or Argentina has a huge crop, and if that does bring that ratio that we talked about, brings it into 2.4 come springtime, will the U.S. just plant more beans simply because it's cheaper to stay in business? Input costs are that much less, so we'll just plant beans anyway if corn stays with that.
The majority of the region that's going to increase their bean acres are the fringe areas. You know, you're going to have to get out of the Corn Belt because the Corn Belt won't vary their acres much. So the likelihood is that, yes, there's still going to be more bean acres because the crop is going to be a little less to plant, and the economics still lead more towards soybeans than they do towards corn, especially when you get into the fringe areas. Now, corn yields have been fairly good over the last few years. So a lot of guys are going to look at the potential that they've had with the increase in corn yield over soybeans. There was a couple of years ago, there was a university that did a study, and they actually came in and said that the corn yields over, what was it, 95 to 2005 or 2006 had increased like 30-some%, whereas soybean yields in that same time frame had only increased 15%. So that kind of has led to why we see so many more corn acres. The potential to get that extra 10 bushels is easier for corn than it is for beans. Now, this year kind of blew that out of the water because now all of a sudden, what are the seed companies calling this? The decade of the bean? They're putting a lot more emphasis on bean genetics and trying to get their traits back into the beans. So yields were pretty good. So again, most guys are going to remember last year, and that's what they're going to go with. And beans were pretty good in most areas. Anything else? Well, with that, I'll let Scott, I think it's Scott, turn now. Scott Anderson's with Cash Cow. We kind of partnered together here in the last year and done some things together. And so for a little bit of diversity, he thought it would be nice to let Scott talk. He does quite a bit of blogs as well, different management blogs that we can push on the internet, and also writes in the Aberdeen Green Sheet.
Yeah, there's a few farm papers that pick up our articles, and then I have a podcast as well, Cash Cow Farmer Podcast. I often talk about what I talk about in the blogs and also interview some interesting people. Got to interview a former Army Ranger a couple weeks ago who started a Wagyu beef operation. Oh, I'm not talking to the microphone.
Yeah.
I recently interviewed a Wagyu beef farmer. He used to be a former Army Ranger. So that was really interesting. I think that one just came out this last week. I just got to get logged in here. Is anybody here familiar with Cash Cow Farmer, the financial software? Management software? You are? Just one or two. Anybody got the chance to talk to Joe Fettig? He's the customer success guy. That's Joe, so you can finally put a face on the name and the voice. Yeah, you need a new hamster in your computer. He's getting a little wore out. Really? It's going okay. So you got a clicker here? This thing? Yep. All right. Yeah, just hit present right there. And then what it's showing on the screen is what you're seeing. So you might want to click on you click there, it shows that screen, hit present. So for the people that didn't make it, we're trying to record this so we can share it with those that didn't make it and then other people as well. So Randy, there's going to be thousands of people watch what you just did, hopefully, right? Yeah. So first, before I go into the software, I'm going to talk a little bit about some strategies that I use on my farm. I farm in northeastern South Dakota. It's about 2.5 hours from here by Aberdeen. And I farm 7,500 acres of corn and soybeans. And I've been farming for 6 years now. I used to work investment banking in New York City, and that's where I got some financial background that helped me put together the software that came from the spreadsheets that I used to run and manage my own farm. And even though times are tough right now, there's still a lot of opportunity to make money with your farming operation and be profitable. And we're going to go over basically a couple strategies that I use for my farm and that I guarantee can help your farming operation as well. And then I'll show you exactly how the farm software program works as well. So maybe I'll just use the mouse. So this is a fun quote from Warren Buffett. When the tide goes out, you discover who's been swimming naked. And for those of us that have been around for a couple of years, in the good years, really, I mean, there's a lot of people that started farming that probably shouldn't have started farming when things were good and things were easy. Now that things aren't so good and not so easy, we got to do a lot more work to make any money these days. And so really appreciate Warren Buffett's advice. So I did some analysis of the current market situation. This is what I came up with. Can anybody relate to that? So it could be worse though. And I put together the 10 key metrics that I use, and I look at these metrics on a regular basis. It's like financial push-ups. I mean, if you get up in the morning and you do push-ups and sit-ups every day, over time you're gonna build a great physique and you're gonna be in great health. The same is with financial stuff. The more time spent on financial planning is directly correlated to exactly how much wealth you have and obtain. And I know sometimes it's not fun to crunch numbers and to be looking at data points all the time, but the numbers never lie. They always tell you what's happening in your operation, and they can help you overcome the emotional challenges that we face when it comes to grain marketing, you know, managing contracts with landlords and whatnot. I mean, nobody likes to drop land from their operation, but when the rents are too high because of the good times, I mean, a guy just has to look at the numbers and say, this is the reality. I can't afford to farm this land anymore, or renegotiate those rents down or something like that. So the first key metric is our cash positions. And every single week, I have a bookkeeper that comes over once a week, and we write down our cash position on all of our bank accounts, all of our savings accounts, bank accounts. We write down personal, business, everything. It's just an exercise that we do every single week, making sure that we know where we're at on a cash position at every week, because you never know when a check could clear and all of a sudden your cash position is low and you got upcoming liabilities or something like that. So exercise number one of my favorite is the cash position one. The next one is debt balance. So always knowing exactly where you're at on your credit cards. They can sneak up on you. You never know. You go to Menards or Lowe's or something and buy a few things, and next thing you know, you got a huge credit card bill, or your operating line of credit. Always knowing where you're at on your operating line of credit, exactly how much room you got left. You might have a big bill coming up that you got to take care of, or you took your combine into John Deere and you got a big credit card charge or something. I mean, you never know. Or Titan machinery, of course. And then your long-term debts as well. Land, equipment, always know where you're at on a regular basis. So the debt balances aren't a weekly exercise that we do. It's more monthly, especially when it comes to the credit card stuff. We look at it every month. And then the long-term debts, I mean, those we look at every quarter, basically. Inventory. Now, there's 3 types of inventory that we look at. It's old crop, the stuff that you've got in the grain bins, new crop, the stuff that's growing in your field, and then next year's crop. We have just a corn and soybean rotation on my farming operation, so it's not that confusing. We generally have about a half and half rotation. So I can plan up into 2020 if I'd like to, because we kind of know exactly how many acres of corn and soybeans we're going to do, and we know about where our APH is. So we could technically start marketing 4 years out if we wanted. But having a good idea of where your inventory's at in your grain bins at all times, you never know, you may need to make some sales for cash flow reasons and whatnot, but always knowing where your inventory's at. And that's something we do every quarter. And then in season, we'll adjust things. So we had a hail system come through this year, and it took out about 1,800 acres of corn and beans of ours. So we had to adjust our new crop inventories down because those acres were impacted, and so was the inventory. That way we're not getting in a bad position with grain marketing. Has anybody marketed more grain than they grew besides me? I'm the only one? All right. I'm sure there's a few. You don't have to be shy. So number 4 is the payment schedule. And this is basically when the liabilities are due, especially the big ones. If you've, like me, I've taken out loans for equipment, various different equipment pieces, land, all kinds of stuff. So it's due at different times of the year. I got a contract for deed on land, got equipment payments at Wells Fargo, at my local bank. You know, I mean, a young farmer like me is usually in debt up to their eyebrows, you know, so we always have things going on. So understanding when these payments are due is extremely important, because you got to make sure you got cash. It's great to have a whole bunch of corn in the bin, or soybeans or wheat or sunflowers, but you can't pay your bill with the grain. You got to figure out a way to either take a commodity loan out on that grain and have cash on hand, or at least credit on your operating line in order to make those payments. So that's extremely important to know. Good exercise, something that we do every quarter. Cash flow, statement of cash flow. How many people here put together a statement of cash flow every year? Good. It's probably the most important statement that you're going to go through, because businesses don't go out of business because they're not profitable. They go out of business because they run out of cash. And that tends to happen to farmers because we have such a crazy cycle with our cash flow. I mean, we get most of our cash at harvest time, or whenever we sell the lion's share of our grain. For me, it's usually in December I'll get most of my cash, and then usually in July when I clean the bins out that I've stored grain in for next season's crop. So I'm really only getting revenues twice a year. And if I'm not smart with my cash flow, and I don't have a big enough operating line to get me through those lulls of the revenue stream, it could be a really challenging time, especially the young guys out there. Also, commodity sales plan, which goes with that cash flow. You want to make sure that you're raising cash, or at least doing a commodity loan at the FSA, which I highly recommend commodity loans. Anybody ever done a commodity loan before? Interest rate 1.25%. At least that's what I got last year. Haven't done one this year yet, but I mean, the money is almost free, and it really gives you a good amount of cash to be prepaying expenses, because prepaying expenses is probably one of the biggest savings you'll get, not only on taxes, but I mean, when you prepay your seed, you lock in the seed at the earliest opportunity, you're going to get 10%. I mean, that's easy money right there. Easy money, low-hanging fruit. Production costs, input spending trends, labor, repairs versus buying new machinery. So really knowing where your input costs are, exactly how much you're spending on urea and where that's trending. So we looked at our fertilizer. We fertilized at the fall of 2015, in the spring of 2015, and now. And from the fall of 2015 to the spring of 2016 this year, our fertilizer price came down by 15%. From this spring to this fall, the fertilizing price that we locked in was also down another 10%. So looking at those trends, you know, commodity prices have been roughly the same. I mean, they've up and down, but we've had the same opportunities. And
seeing that the price of, you know, fertilizer is coming down 10%, it gives you a lot more confidence. When you go in and talk to your banker about what's going to happen next year, you can say, hey, we're down 10% on fertilizer, likely also going to lower our break-even cost of production, which is the next thing, knowing your break-even cost of production across the whole farm. So what exactly does it cost to grow a bushel of corn, soybeans? I mean, not taking just the rough estimate, but actually going into every field and saying, okay, this is how many pounds of fertilizer I put for all my different fertilizers, how many ounces of all my different chemicals, and all the input costs, all the overhead costs, your labor, your insurance. I mean, really getting every expense into your farming operation, saying what exactly is my break-even cost, so that you know, can I afford to be growing corn? Can I afford to be growing wheat, soybeans? So my dad invented the Anderson opener about 30 years ago. And anybody familiar with the Anderson opener? The old Concord drills and Flexicoils, the little hoe drills, they call them. So he used to use that a lot. And we farmed wheat for a long, long time. But when I came back and started crunching numbers, we were farming corn, soybeans, and wheat. And I'm like, Dad, we're not making even half as much money on wheat as we are on corn and soybeans. Yeah, it's nice to spread the operation out and spread the chemical program out. So we're kind of hitting the weeds with different sorts of chemicals. But I'm like, we're really not doing well on wheat. I think we should drop it out of production. And for him, being kind of the wheat guy and the no-till guy, talking all over the world about no-till farming and his invention, it was really tough to drop wheat. But I had the economics to show him that, hey, I mean, let's just farm what we're getting paid to farm. The market's always right, even though we may not agree with it. So we dropped wheat out of our production about 3 or 4 years ago, and it's been a good decision, especially when you look at what's happened in the past couple of years with the price of wheat. And, you know, the customers that we have in the software program that farm wheat, I mean, we sit down with them regularly, and we're trying to figure out what to do. You know, what other options do we have for wheat? And so there is some good farm programs out there that one could consider, you know, going into CSP and equip in one of those programs, especially if you can get cover crops in. You should be able to collect another $20 to $30 an acre with some of these FSA programs. So this is something that if you're ever complaining about basis, you're really unhappy with. So this harvest, I called the elevator in the morning, and I was going to do a basis contract, and it was at, I don't know, 60 cents or something like that, 54 cents corn, and I was like, you know, I just got to see how many bushels. Let me call my farm manager and see how many bushels we got, and then I'll call back with the basis. And I was like, what do you think the chances are it'll go up between my call now and later? And he's like, oh, not very. I don't think it'll go up, but you never know. And so when I called back, it had gone up by 2 cents, the basis, just in like the 3 hours. And I'm just like, he's like, oh, it's gone up 2 cents. And I'm like, well, I want to lock in 100,000 bushels here. And he's like, sorry, I can't do it. So I called the marketing manager and said, hey, it went up by 2 cents. I called in the morning with the intention, can you just give me the 2 cents? And he's like, no, can't do it. So of course, as a farmer, I called the neighbor co-op and sold the grain there to drive by that one. But I mean, basis, you know what I mean? Sometimes it makes you feel good to do that once in a while. But anyway, co-op, the basis is one of those things that it changes so often, and it may just be a few days where they dip it down and they get enough people, or they call the farmers that they like, which apparently isn't ever me, it seems, because they never call me when the basis is awesome. I just have to luckily find out. So one exercise that we do is write down the basis every single day, and I would recommend doing this twice a day, just in the instance that, you know, they drop it down for a couple of hours and then they put it back up, because you never know what's going to happen. So I would recommend every day looking at the basis at the co-ops, the ethanol facilities, and if you have opportunities to ship it to feedlots, just making an exercise, doing those push-ups and writing down the basis every day and saying, okay, what's it going? Because you are going to realize trends. You're going to start to notice things, and you're going to say, oh, you know, it's starting to come down. Nobody else is looking. Nobody's talking about it at the coffee shop or wherever you're meeting with your neighbors once in a while. you're gonna see things, and that's gonna give you the foresight to say, okay, I need to be setting the basis now. And number 9 is the market changes. So one thing that's really helped me is I've got charts up on, I've got a computer that just sits there and connected to 2 monitors like that. And all it shows is corn, soybeans, the dollar, and the stock market. So I've got each screen has the harvest contract for this year, for next year on soybeans and corn, and then the contract is trading right now. So I can see exactly what's going on, and I just look at it every single day. I end up walking by it or something and look at it every single day. And it shows a 1-year chart. So I've got the top 2 are 1-year charts and the bottom 2 are 5 to 10-year charts. And I would really recommend, as Randy said earlier, you really see where the market's going when you zoom out and you take a more macro view on things, and you see what's the trend over 5 years. Where are those points of resistance and support where we should be considering making some moves and putting on some hedges. So that is one thing, that a daily exercise, that's your push-ups, to really get financial stability, because that's helped me a ton, and it's been super good for our operation. And then number 10 is off-farm income. So usually when all the farmers are making money, it's the worst time to be investing in farming. The price of land is high, the price of equipment is high. It's the worst time to be investing in farming. So the smartest farmers I ever talked to, they've always got these side deals they're doing. Some of them do hotels, some of them do restaurants, some of them do commercial real estate. One of the largest farmers in my area, he probably has more commercial real estate properties than he does farmland nowadays, because he took all of his profits when times were good and he invested in some of these commercial real estate properties. And the nice thing about real estate is you can depreciate the asset faster than you can get dividend income from the rents, and you never have to pay taxes on that stuff. Plus you can do reverse mortgages and raise a lot of cash that way. So it's a nice tax thing, because we're always having issues with offsetting taxes as a farmer, because raw land, of course, we can't deduct that. But always keeping track of your off-farm investments and making sure that you have a lot of off-farm investments. I was on the airplane last night coming home, and from the Minneapolis to Aberdeen leg of the flight, I sat in front of 2 neighbor farmers, and so I asked these guys, I said, if you had $1 million, what would you do with it? Where would you invest it right now? They didn't say farming, which probably right now would be a good time to invest in some farmland. But one of the guys said municipal bonds, tax-free municipal bonds, because he's like, I want low risk. They're probably in their 60s or late 50s, and he wanted municipal bonds. And the other guy was going to invest it in commercial real estate for retired folks. So that's basically the 10 key indicators that I follow on a regular basis. Just the exercise, the push-ups, the 8-minute abs to do every day, that will keep your financial position good. If you implement that strategy, I guarantee very soon you'll see dramatic improvement in your net worth and your balance sheet. So now we're going to talk about the data management system, the easy way to keep track of some of this stuff, because one of the most challenging things is trying to make sense out of everything that happened this year, all the different chemical applications, the stuff that happened on the fly, the occasional fields that had to be sprayed by airplane, trying to make sense out of all this stuff. So I'll just briefly walk through Cash Cow Farmer, the data management system that we developed. And there's a handful of data management companies out there right now. Oops, I better log in. There's a handful of data management companies out there. There's one in Silicon Valley called Granular. Has anybody heard of Granular or Conservis Corp? Anybody? You guys are so shy. I don't know why. So I'll just pull up 2015 because that year is pretty complete. This is my farming operation here when it gets loaded. So the whole goal of this financial software is to make sense out of everything and then break it down into a field by field kind of view. Let me zoom in a little bit. What's that? No, I don't. You can open it up if you want. Does that look, everything on there looks like? That's about as big as I can get it without making everything all funny. But basically, the goal is to see which fields in your operation are making you money and which fields in your operation are losing you money. And then why that is. Is there too much rent? Is it the wrong crops on there? What's going on with those fields? So I've got this broken down by corn and soybeans. So up here you've got all my corn fields, 2,842 acres of corn. This was last year, 2015, because everything's complete. So at the bottom here you have the weighted average cost of production for operating, overhead. So operating costs, those are the costs that you can't apply to a specific field. That's the labor, that's the insurance, income tax I have in there, all the income tax that we paid on the farm. I've got, you know, the auto insurance, repairs, equipment, all that stuff. $183 an acre is what we spent on operating costs on 75, I think there's actually 7,300 planted acres, 7,316 planted acres. So most people don't think about that and don't really know, you know, how much, you know, when you put your income taxes in, you put everything all together, exactly what does it cost to operate your farming operation? It can be kind of scary. We've had a lot of people that the first thing they kind of shocks them is their actual operating costs, you know, especially when you take into account, you know, building some new buildings in a house and maybe new shops and grain bins and stuff like that. It can really add up. So this next column is the overhead costs. Now these costs, overhead costs are going to be your multi-peril crop insurance, and I'll show you how this stuff kind of goes together. Multi-peril crop insurance, hail insurance, agronomy, if you got a scouting agronomist, the variable rate prescription, stuff like that. Rent is going to be in the overhead. So you'll see the overhead here varies dramatically. We got a few negative numbers, which I'll break down to you in just a moment, because those fields, they're actually quite profitable because of the hail payments. And Randy's going to like this. This is a good insurance sales tool here. After you see how much money you make when you get a claim on hail insurance, when you get a really bad hailstorm. So with these two fields, 19.2 bushel expected yield or actual yield on this field, that was 19.2. This one was 16.1. And you can see $89 an acre profit and $157 an acre profit was not bad for that low of a yield. That paid for the insurance premiums for a few other fields as well. So that was very good. You've got the seed costs, any sort of custom application, fertilizer, chemicals. So all that stuff is put together real nice and organized for you. You've got your break-even cost of production. So you can actually sort by any one of these columns here. You can sort by which one's your lowest and which one's your highest. So an exercise that we do is we figure out which fields are our highest break-even cost of production and why is that? Is there a low yield on there? Are we variable rating those fields? What's going on with those fields that our break-even cost of production is so high? Are we paying too much rent? I mean, what's going on? Because we don't want to lose money on anything. Can we put those fields into an EQIP program or a CSP program to get a few more bucks from the government or something to help make it work? Or should we just put them in CRP or something like that and just let them go to grass? At least you'll be paying the taxes, you know, if you own it. If you rent it, you may consider not renting it anymore. So that's how it goes for corn and soybeans. You've got everything nicely organized there for you that you can actually sit down and look at your numbers. So this bottom here is our weighted average cost of production for corn in 2015. I just put the taxes in there not too long ago. It was down by $2.47 cost to produce a bushel of corn. Now after paying income taxes, it was $2.88. So I mean, that really adds up in a hurry when you get all of your numbers in here. This basically accounts for every single nickel spent on the farming operation, and then, you know, everything that we can realistically deduct for personal expenses as well, of course. So $82 an acre, look at the corn, and then you've got the soybeans down here, not quite as good, and then you've got your whole farm. So no matter how many different commodities you farm, we got guys growing popcorn, cannabis, right? I mean, just about anything. The first cannabis field was harvested in Minnesota this year. I posted it on my Facebook page. It was interesting how they do that. So anyway, how do you get to this point to where everything's all slick and organized like that? Well, the first thing you do is you put together your price list. And this is where all of your expenses and all the prices you pay for your seed, fertilizer, and chemical are nicely organized. So here you've got the operating costs. Now these are all those costs that aren't applied to a specific field, just the cost to really run your operation. So we've got land costs, some land purchase expenses, there's insurance, there's some taxes, there's repairs, labor, fuel, machinery. I mean, there's everything that we spent. There's a lease, there's hedging losses there. Sometimes it's okay to lose money in your hedging account. And then income taxes there. So it's real easy to add things. You just hit the plus button, you type in what you want, or you can use a couple of our categories that we selected. Type in whatever it is, and then you just type in the amount. It's very easy to add and remove expenses to your operation. And then you just hit that X button to remove it. Next thing is you put in your actual inputs. So we've got our corn right here. Corn, soybeans, I mean, whatever commodity you're producing, we likely have it in there. If not, I can put it in there in just a few minutes. So these are all the various types of commodities that our customers are growing nowadays. I mean, teff grass, tobacco, tomatoes, all kinds of different wheats and whatnot, sorghum, peanuts, pecans, about everything you could imagine to be growing. So you select your commodity, you put in your type of seed, or you type in your type of seed with the other thing here, your variety, the cost per bag, bushel, century weight, whatever it is that you're buying it in. And then that'll actually get put into a database. So when you're building your individual field, you can grab that seed type and then put it in there. So real easy to knock things off, hit the X. Fertilizer is very similar, actually a little bit easier. You just hit the plus button, you type in the fertilizer name, and then the cost per ton or pound or whatever you're buying it. And then if it's a dry application or a liquid application, then you'll have to do a volume conversion, like a liquid fertilizer converted to volume, which there's an example right here. 1034, $49 a ton. Oh wait, 495. I got this thing so zoomed in, it's not really showing everything. But $495 a ton, liquid application, 11 pounds per gallon is what that comes out to. So chemical is the same, type in the chemical, and then the cost per gallon or per pound or whatever it is. Once you're done with that, you hit save. You can go back and forth and edit things at any time, which is really slick. The other nice thing is, let me just pull up the view version here. So this is how it's, when I talked about tracking trends in your prices of your fertilizers. So here, look at urea. Well, I guess urea didn't change all that much. We've got anhydrous. You know what? Let me pull up 2016. We got more volatility in the price of fertilizer for 2016 here. So 2016, I did some spring and then some fall. So here's anhydrous. Anybody use anhydrous in here, or everybody urea? A few anhydrous guys? Okay, good. So $620 is what I paid fall of 2015, and spring of 2015, I paid $515. I mean, that's huge. That's almost 20% down on anhydrous. I mean, and you can tell the difference in profitability on the fields that I applied the fall stuff versus the spring economics. It's pretty dramatic. So it's like that with everything. Mez was $60 a ton cheaper in the spring. Ammonium sulfate was $45. Potash was, 80. So I mean, it's pretty crazy how volatile things can get. Also, I've got some prepay Power Max and some other stuff in here, I believe. Well, maybe that was last year, but you could really tell how things get changed dramatically just on your economics. I mean, just a few bushels will change that break even pretty dramatically. So how do you get there? Well, that's the first step. The second step is putting in the field. So you just type in the field name, the legal description, you select whatever commodity you're going to grow on this field, the legal acres, the planted acres, and then your expected yield. This field, actually, let me grab one of those hailed out fields just for Randy here. We'll sell a little insurance on the side. So this is a cornfield. We're expected to get, let's see, where is this? Yeah, like 168 bushels, I think that was what we fertilized for. And we got 19.2 because we got hailed on. So the economics, the overhead costs. So that's the rent, taxes. If you don't have rent, you'll have a tax on that land. You got agronomy, variable rate prescriptions, insurance, a few other miscellaneous things. So this is the spot where we can put in those payments. So the hail payment was $247.59 an acre in revenue. The multi-peril payment was $308 an acre in revenue. And then how many people keep track of their government payments? You know, that actually adds up pretty quick. I mean, $36 an acre on this field. Some fields are $70 an acre, and it's all over the board. You never know what I mean, it's just almost impossible to figure out what you're going to get, because if it's a different county, or if you're administering out of a different thing, you remember that whole mess, right? You administer out of the wrong county and you don't get any money. So you can really keep track of things really good here and apply those payments to those fields. You might have a field that you feel like you're paying too much in rent, but if you look at the government payment on that field, it might be way higher than the other fields to offset some of that. So really understanding where your government payment's at is really important. It's easy to add and remove things. For example, I have a couple fields that when we finish corn, we'll put electric fence up, or our neighbor rancher will put up electric fence, and then he'll graze them for 50 cents per head per day, which adds about $7 or $8 an acre usually. So I can just hit a plus and write, you know, cattle grazing and $7 an acre in income off that. And then that'll change the economics and break even and profitability on that field. The next thing is the custom applications. I mean, it's very easy to do this stuff. You just type in whatever custom application it was, harvest, aerial spray, whatever it was, cost per acre, and then how many acres they did it. And then you can obviously put in the date so you can keep track. In case your neighbor says he sprayed my wheat, you would have the date in, if you get a little drift, you have the date that it was sprayed. It's never happened, I'm sure, to you guys. Any notes, of course, so you want to take a note of wind speed or whatever during spraying, or hail on this date. I mean, everything is just, it's nicely stored in the cloud. I mean, that's one thing. We have so many things that we have to remember every day. It's nice to just put something down and then store it in the cloud and never have to worry about it again. And if you need to go back to it, you can just, a few clicks and you have the information at your fingertips. So this is where you put in the seed. So we can select whatever corn seed we put on this field and grab that corn seed. We put our planted population per acre right there, whatever the monitor said, or whatever after the plant date. You put your plant date in here, and then how many acres you planted. Fertilizer, just the same thing. You grab one of the fertilizers. Sometimes you'll grab the prepay, of course. Sometimes you'll grab the in-season fertilizer, how many pounds or gallons or whatever it was you put on there per acre and the date. And then the chemicals as well. You just hit the plus button. If you need to add a chemical application, you hit the plus button. You grab your Power Max in-season or prepay, whatever it was, and however many ounces per acre, and then you're off to the races. So you hit save, and then you go back to, you hit save, and it's going to automatically take you back to your field summary page where you have all your data nice and organized and laid out. So that's basically the software program. Does anybody have any questions on how it works? Is anybody using a software program or a management system? How many people use Excel or Excel? That's what I started with too. 28-page Excel spreadsheet. And I mean, it works good for you, right? But I was trying to help other farmers, and that's where I was like, I tried to share my Excel spreadsheet, and I was like, oh, that's not going to work. So then we put together this program. Go ahead.
Just curious, under the input cost.
Yep.
By the top acre cost, it doesn't seem like you should have a negative number.
Yeah, and so that the reason why that number is negative for those two fields is because the insurance payments were more than all of the costs in order to put that together. So it actually shows negative. It should just be zero, but that's how much per acre, you know, the insurance overpaid. No, how we calculate this is we take the yield minus the difference between the cash price and our break even. So it's reflected in the break even there. Yeah, I mean, we should just, I guess, having zero there would be enough, but that's how much our insurance payment was exceeding our cost there on those two fields. I think those are the only ones. Yeah, everything else. Let's see my highest cost of production field, 623. And that's a rental ground too, so that's going to have some rent in there.
Does that go through then when you're looking at the bottom line?
Yeah.
Or that you've got the insurance income taking away some of the costs?
That's right. Yeah. So when you look at the corn summary, you got $82. You can actually toggle this over to, instead of dollars per acre, you can do dollars per field. And this will tell you your profit and the dollar amounts as well. So if we go down to the summary thing, 1.198 million is what it cost to produce the corn. There was 415,000 bushels, break even 288, and then the net income was 233.
So that 1.1 also has the insurance income.
Yeah, that'll offset. That'll be offset. Yep. Yep, that insurance income will offset some of that cost there. That's true. One thing I didn't show you is the contracting pages. So when you're making grain marketing contracts, how does that impact your bottom line? And you can do that in here. So this was 2015. Luckily, we worked with Randy on grain marketing and had a few home runs there. But there was quite a few bushels sold at 360 cash, 361, 365, and these are the appropriate bushels. It'll do your weighted average sale price. So if you take all these numbers in, and then you sell the rest, the 115,000 that's left at 299, your weighted average sale price, sale amount, dollar amount is going to be 344. So that's what it's using for your revenue side of things, assuming you sold everything right now at the market. This is connected to the futures market. So if the futures market goes up 10 cents or down 20 cents today, for example, with beans, it's going to change every night. So once the market closes today, the futures are going to renew, and then that's going to be reflected on your P&L the next day for your unsold inventory. Of course, if you've got marketing contracts that are already sold, then that'll remove that from inventory. So in order to add a forward contract, you just click that button, you pick the buyer here, the co-op, and then you select whatever commodity you're growing, the amount of bushels, and then the price in dollars and the basis in cents, and then you click save, and that'll adjust everything. So if I sold 90,000, let's say I did not do a good job, 90,000 bushels of corn at basically 190 cash price, and save that. Notice how that terrible sale of the 90,000, which was a large share of my inventory, dropped that down from 344 to 321. So that really brought down my weighted average sale cost, which is also going to impact that corn. So if I crack open that corn again, the summary page, I just open a new tab. It was like 266,000 was the income. So if I switch over to the field costs and go down there, I just knocked off, 130,000 in income because of that sale. So you can really see how important those marketing decisions are, as we all know. So if I were to take that off, I would be back up to that 266. Now we're back up to that 344 weighted average. And if I refresh this tab, it'll go back up to that 266. Does anybody in here use QuickBooks for their financial stuff. QuickBooks is great, but it gives you the macro view, you know, the zoomed out view of total expenses, total revenues and whatnot. It's really hard to break it down by a field by field basis, which is really what you need to know to properly manage a farm. You know, we have a couple, there's a few other companies that are doing farm management software, but the problem with them is that depending on how big you are, the cost to get going is quite expensive. I mean, it's $10,000 minimum, or $2 to $3 an acre, depending on what you're growing, you know, with the 10,000 minimum. So I started this company to give other farmers the chance to get going on farm software to compete with the big farmers, because the little guy doesn't really have a chance anymore. You can't get the best deals on pricing. The co-op doesn't care about you. And, you know, to use a software tool like this, it's just too expensive, and their software wouldn't be the best fit for a smaller guy because it's just too burdensome. You almost need a full-time person to do it. For this, you could have your bookkeeper do it, or whoever helps with your financial stuff, or you could do it no problem. We have guys. Who's the oldest guy you've talked to that uses it? Like 70s, 72, yeah. So pretty easy to do. And we work with Randy, so if you're part of the marketing deal, we usually make a good offer for people who are working with Randy as well. Any more questions? What is the cost? It's $749 or $14.99, depending on how many fields you have. So 25 fields or greater, it's the higher level. Per year, yeah, per year. What's that? Yeah, and we're probably going to readjust upwards this next year. Yeah, January 1st, we're gonna move the price up to probably 1,000 and 2,000, and we'll probably do a monthly program, a monthly deal instead of paid in full once a year. Just where kind of the market's going on that. So we try and price it so that the small guy can get involved in that and not see a big impact. What's that? What do you think?
Well, I looked at it. I'm not a very big farmer, so I don't know how.
Yeah. Yeah, our smallest customer is what, 300 acres maybe? Yeah. Yeah, I mean it. $749. Yeah. What's that? Well, we grandfather in the people that started. We started less, and then we slowly been. I mean, we've been around for just over 2 years now, so we started out lower. That's right, yeah. Or sometimes before the first of the year. I mean, you procrastinate on anything, and it's going to cost more money later on. So, just like anything else.
This is just the analysis. Doesn't do the same thing as or it doesn't also do your farm records for tax preparation. No, your QuickBooks will do that. You know, you're going to use QuickBooks no matter what. There isn't a farm software program out there right now in regard to this or the other competitors that I talked about that actually have like the checking account and reconciliation with your banks and stuff like that. Yeah, we don't want to do everything, just the most important part. And just the exercise of putting your information in there, you're going to find enough issues. When I go through the co-op bill, every time I go through the co-op bill, I pay for this program 10 times because I have to put the data in so that it makes sense in my system. Because they're always mispricing things. Oh, they didn't give me the prepay price on fertilizer. Oh, that was $20,000 extra on that bill. You know, you just find a lot of crap when you actually take the time to sit down and do the push-ups and do the exercises that, you know, this gives you something to put the data into and make sense of it. The spreadsheets are great too, but it's a little more time consuming, and, you know, you got to be a little bit more savvy to run a spreadsheet and write formulas and stuff like that.
So for forecasting, yeah. So one nice thing is it takes a little bit of time to get all the data in. So if you want to go to the next year, like let's say 2018 or 2019, all you do is you add a year. So let me click on that's the field. You just add a year, you type in the next year, and it copies over all your information. You just switch the crops on your field. And so this time of the year, we're going to be sitting down with our soil scientists and agronomists and figuring out, okay, what are we going to do next year? What's our expected amount of fertilizer we're going to put on there? Because everything's pretty much zoned up at this point. And we have a chemical plan, and we're just going to forecast. All the corn's going to get this sort of chemical plan, the ideal plan, you know. Soybeans are going to get this pass and then this pass, and we're going to put that out there. We'll have a budget. I mean, I have to put together a budget anyway for the banker. So we do that, and then as the season goes on, we change things as necessary. If we have to heat up the chemical, we add the stuff, you know, the extra chemical that it takes to do that. And then we usually have like a $15 an acre buffer in there, so that we might just add to the input cost, so it's over every acre, and then we can remove that just to be good on forecasting, you know. Yeah, it's easy to build a budget. I mean, you can build a budget real quick. And we have the bulk applicator now. So if you wanted this little button here, you can click that and you can apply the same seed over all your corn, or the same chemical over all your corn acres or wheat or whatever. You can bulk apply, mass apply applications, and it saves a heck of a lot of time. Go ahead. Oh. Sold. You just go to cashcowfarmer.com and you just click the learn more deal. I think it's learn more, or sign up, and then it'll take you through a series of steps. No, you can try it for free before you pay. Like you guys can try it for free for 30 days before you pay. Yeah. Yeah, like I just logged into Randy's computer here, and no, it's stored in the cloud. Yeah. And the nice thing is secure. Yeah, we use the same security that like Wells Fargo uses. Like there's a secure net, there's a secure login. It has like the little, see this little lock here? That's the secure sort of server. Yeah, we do. Everybody that's interested, we do. Joe does a screen share. Well, he'll share his screen and walk through how to do everything and help you put in your first fields and stuff. Yeah, as much as you need. I mean, we're here to help. So we usually just do it remotely. You know, just like you break your computer at any point in time and they log in and see what's going on. You know, most guys write it down like you, and then they either hand it to whoever writes the checks and stuff. Sometimes it's the wife. Some guys have a bookkeeper or somebody that takes care of that stuff. But yeah, it could be either way. I don't even do the computer in the thing. I just have my guys send me. They take a picture of the planner monitor when they're done, and they send it to me. Yeah, same with them. Yeah. Yep. And I know. I had a neighbor tell me this year he's one disaster away from paying for the farm. Yeah, one more disaster and we'll have this farm paid for, he said. I don't know what he meant by that, of course. But yeah, I mean, it's just a tool to help you really dial in and figure out what's going on in your business, so that you don't have to sit out there and just work like crazy hours and then come home and not have any money in the bank. You know, that's the worst feeling in the world, when you just sit there and grind it out and stress out, and then you come home and miss marketing opportunities and all kinds of stuff. I mean, you guys are already ahead of a lot of other farmers because you're here and you're working with Randy. I mean, Randy's not perfect either, but at least I sleep at night because we've made some sales, and you know, I'm happy with where we're at. It's even though it's, you know, we oftentimes think we should be sold at the top 100%, but that mentality doesn't get you anywhere. I mean, oil companies and, you know, airlines and all these companies, they have a whole team that any commodities business has a whole team of people that manage the volatility and hedging for their business, or you'll be broke. So I just hire Randy and sell when he calls. I don't look at it as much anymore, except the basis, you know, that's something we got to watch every day. So, any other questions? All right, well, thank you. Close this out. Oh, there we go. You gotta finish it. Okay.
Okay, it is 2 o'clock. I don't want to keep you too long. If you need to go, feel free to leave. I'm going to talk about whole farm revenue protection. Hopefully I can get to this in, I'm hoping like 15 minutes, get you out of here. I just want to give you an overview of it. Go buy a new laptop tomorrow. Touch it. Okay. What whole farm revenue protection is, this is a federally subsidized crop insurance product. It's been around for a few years now. Not much sold in North Dakota. It's not terribly popular up here yet. I think the bankers are right now more excited about this than the farmers are. And you'll see a pretty big liability number you can cover for not a lot of premium. And that's why this is getting a lot of bankers' attention. This is, I talked about this a little bit before, it is going to insure all of your farm revenue. Animals and crops. Think of it like an umbrella policy sitting over your RP policy. We do need 5 years of your Schedule F data to do this. I don't need your whole tax booklet, I just need the Schedule F. Like I said, you can buy this with your existing RP-YP policy. You can cancel your RP-YP and just take whole farm. The one restriction is you cannot have any cat coverages. And I think the reason for that is it's because of the subsidy is so high on the cat, you kind of, it's almost like a double dipping subsidy thing. So even if you have, let's say you have oats on your policy that you haven't grown in 10 years and it's sitting there as oats cat coverage, if you don't cancel that, that kicks you out of this. So you need to be aware of that. You cannot have any cat coverages anywhere. If you do keep your revenue protection policy, you're going to get a really big discount. And this will be one policy per tax entity. So if you farm in 3 counties, it's one policy for whole farm. If you're across state lines, it's still one policy because it's one tax ID number. If you have 2 or 3 different tax entities, then it would be 2 or 3 different policies. And again, you've got to have 5 years of Schedule F. We have to have that. No more than $1 million of revenue from animal products. You have to have 5 years of records. You have to have been farming for 5 years with that same SSN or tax ID number. The only exceptions are if you have an SSN and you incorporate and nothing else changed, we can take your old records and your new records and stick them all together. If you buy a farm and you take the whole thing over and the previous owner will give you the records, we can use that. If you're beginning farmer rancher, we only need 3 years of tax records instead of 5. And again, this is called whole farm because it's measuring the revenue on your whole farm. If your guarantee is $750,000, It doesn't matter if that comes from corn or soybeans or cattle or wheat or whatever. As long as you make that much revenue, that'll determine whether you have a loss or not. All we're looking at is bottom line revenue here. If you have 2 or more commodities, which just about everybody does around here, you can get up to an 80% subsidy level. And again, this is why bankers like this. They see these prices. You know, enterprise units give us an 80% subsidy only until 70. You can take this up to 75 if you have at least 2 commodities and still get that 80% subsidy level. Plus, you get a discount for having an RP policy. And we'll go through that. It does say, too, to qualify for 2 commodities, the second one has to be 17% of your total liability. To qualify for 3, the third commodity has to be at least 11%. So you can't have 3,000 acres of corn, 3,000 acres of soybeans, and plant 50 acres of wheat to try to get a third commodity. Has to hit those limits. Your guarantee is going to be based off of the lower of 2 numbers. One is we look at your income, your farm income on your Schedule F, that average for 5 years. They do some indexing, or that farm operation report is what you plan on doing this year. I'm going to grow 5,000 acres of corn. I want to get this yield and this price. I'm going to grow 1,000 acres of wheat with this yield and this price. It's the lower of those 2 numbers. And that we do have to watch. If you're, like I said, it's the lower of the 2. So if your 5-year history hasn't been great, and this year you picked up some more land, you're going to do all these new things, and you're going to have this great year, you're never going to have a loss because it's the lower of those 2 numbers. So if your farm operation report of what you want to do this year is much higher than your 5-year average, you probably shouldn't buy this product. We were talking to the guys from Hudson Crop Insurance. That's one of the companies that's really into this. And he said about 50% of the time, he tells the guy not to buy it. So it's not for everyone. You have to have the right financial situation for this to work. You have a loss if your allowable revenue falls below your insured revenue. Your allowable revenue is just basically your farm revenue plus your inventory plus all your crop insurance payments. Basically, it's your crops, your sale of your animals, breeding stock don't count. Yes, sir. That one.
There, yeah. Your taxes will show the cash sold during the year. This takes the cash sold during the year plus your inventory, which is typically most previous.
It's just that crop year. They'll weed out the other stuff. So if you have old crop you sold in this year, they'll subtract that out. If you have stuff still in the bin, they'll set a price for that and add it in. That's just really that 5-year average is just like a baseline, because they don't want you to say, oh yeah, I think I can have income of $800,000 and your 5-year average is $200,000. So that's just kind of a check to keep the numbers in line. Crop insurance is a little tricky. You can't count it for the 5-year average part. For that revenue, you don't count it. But if you have a loss, they count it against you. Yep. They basically, there's only a couple lines they take off the Schedule F. They don't look at, it's not just taking a total off the Schedule F, there's just a couple lines they look at. And there's only certain numbers of income and certain numbers of expenses they will take. Revenue not allowed, past crop insurance claims, hedging income, custom hire, all those stuff. If you have an off-farm job or your spouse does, those wages aren't included because it's not farm income. So we only care about the farm income. We only can get the Schedule F numbers of farm income. Again, a lot of forms for this one. It's not as bad as it looks, but you've got to be prepared to do some level of paperwork for this one. So I just threw an example together, and my expenses are just totally made up numbers. But let's say you had $500,000, $500,000, 600,000. They're going to make that an average of $663,000 over the 5 years. They do some indexing behind the scenes, which is some complicated math I'm not going to get into. Expanding operations, if you picked up another 1,000 acres of land this year, we'll factor that in, and we'll bump that 5-year average up to 35%. Current year expenses, they do look at your expenses on your Schedule F. They don't really mean anything unless there's a loss. And again, it's just kind of it's a check and balance thing. They want to make sure that your current year expenses are within 70% of your 5-year average, kind of forcing you to follow good farming practices. So you can't decide to tank a year by not putting fertilizer down, by not spraying, by not doing whatever. You still have to follow good farming practices like any other crop insurance product. So this is the farm operation report. Like I said, it's going to be the lower of your 5 years of Schedule F numbers or your plan for what you're going to do in 2017. And this is where this gets nice, because sometimes your APH is really lagging in terms of what you're doing today farming. And you think sometimes you're getting a lot higher price than a crop insurance price. So this is, you're going to say, you have to fill this out by March 15th. And it's going to say, I'm going to grow wheat, you know, at this yield, a 65-acre yield, at this price, that many acres. And you're just going to do that for every crop. If you have cattle, if you're going to sell 100 steers, we're going to put that down in a price. What's nice about this is you can put a yield that you can justify. It can be higher than your APH yield as long as you can justify it. The price is whatever forward selling you've done if you have to have the price and the basis fixed. Cash contracts. If you have cash contracts, you can use that higher price instead of the crop insurance price. So we do that on March 15th. That's either this set of numbers or your 5-year average, the lower of the two is what your guarantee is based on. You revise it July 15th at acreage reporting time because you never plant exactly what you intend in March. And then you do a final one at the end of the year of really what you actually harvested. So I grabbed a farmer in Grand Forks County and I put in, he had $324,000 liability in his MPCI policy. That was the value of that sheet I just showed. Even though he has 5 commodities, they're only going to count 4. The dry peas was only $24,000. It wasn't enough to hit the percent, that 11%. So just because you're farming 3 or 4 or 5 or 6 commodities does not mean we're going to count them all when we calculate the premium. So this is a guide last year. Wheat, corn, dry beans, dry peas, soybeans. On his MPCI policy, he had $324,000 of liability, and he paid overall $10.89 per acre, average of the whole farm. And here's the quote. And this, again, this is why the bankers last year, it was really catching some guys' interest. $438,000 of liability, you're paying $3.56 for. He has enough commodities to hit this 80. Again, you can't hit the 80–85% levels unless you have at least 2 commodities. He does. So that's getting pricier because there's less subsidy. But still, 80% was less than he's paying for his 70% RP policy. And at 80%, it's guaranteeing him $500,000 worth of revenue. That is if you keep your underlying policy. If you say, forget it, I'm going to throw all my eggs in this basket, I'm canceling my RP policy, premiums do go up. So instead of that $356 at 70%, we've doubled it. So you do get a significant discount for keeping your RP policy. And it does count against you, revenue-wise. So if you know your liability there is at $438,000, if you had a $100,000 crop insurance payment, they're going to count that as revenue against you at loss time. But that's why you get the big discount. And again, we start with your Schedule Fs. We're going to end with your Schedule Fs. We can't pay this until you file your taxes. Unlike other crop insurance, well, after that acreage report, it's set. We can't change anything. This, they can keep changing your guarantee if they find a lot of discrepancies between what you said you were going to do and what you actually did. Replant payments, there's a lot of verbiage there, but all that is really saying is if you have a crop insurance policy that has a replant, that'll pay the replant. But if you don't have crop insurance or that crop doesn't have a replant payment, this will pay a replant. Which for here, that's not really too big of a deal. This I stole from Hudson's presentation. This is what they say the advantages are. It's covering revenue. Doesn't matter as long as you're short revenue, doesn't matter which crop it is, if it's livestock, if it's your corn, whatever. Just covering revenue. Protects against loss of revenue to basis drops from spring estimates. Commercial grain drying charges allowed. That shrink one they're talking there is that, crop insurance deductions and how the elevator deduct never ever match. And in this one, you don't care. It's just the revenue. Specialty crop contracts are used if you have malt, barley, food grade soybeans, anything like that. We will use your contract price to establish your guarantee. No added cost for high risk land. Not that that's a huge issue around here. If you have unrated land too, that would be covered. And again, it is highly subsidized at that 80% level. I know I went through that super fast. Anybody have any questions on that? Yes.
Have you done a real-time comparison? Because, you think back for those years, question, the prices were double.
Yeah.
Theoretically, it's true. Revenue is true. Same with livestock.
And it's going to be the lower of the two. So if you look at that 5-year average or what you plan on doing this year, and it's the lower of the two. So if you've had really good years in the past, it's bumped your income up, it's going to see what you're doing this year. That's the check in it.
They really don't count. Yeah.
I think that 5 years is more of a check if it's the other way. Where you've had these really low years, and all of a sudden now you think, oh yeah, I can bring in $800,000. Well, historically you can't. That's the check too. And again, that's why this doesn't work for everyone. There was the old AGR, the old adjusted gross revenue policy, which I don't think was ever available in North Dakota. AGR Light was, it never really caught on. I worked with this a lot. used to work at Nordic Mutual, and back then it was the apple growers in Michigan that were buying a lot of the AGR policies. This used to be targeted to all fall crops that weren't serviceable by crop insurance. RMA has really changed this now. They are focusing on row crops for this. I think mainly because RMA has staked out a pretty hard line against fraud, waste, and abuse. They don't see a lot of fraud, waste, and abuse with this because you're probably not going to lie to the IRS. That's why they're subsidizing it so heavily. They actually made a change this year too, that if you have irrigated and non-irrigated of a crop, those are two commodities now. So a corn and soybean grower who's got some irrigated land could now have 3 commodities if you count the irrigation as a separate commodity. What? Yep, wheat and winter wheat are separate. Spring wheat and durum would be separate commodities, even though for crop insurance they're all considered wheat. Yeah, I don't know if they are not. I have to look at the drop down, see if it's. So like I said, this won't work for everyone. Actually, I've got, one guy gave me his stuff. I've got it sitting on my desk. I need to send it in and get a quote for it and see. Again, look at the numbers of the last year, what he's done compared to this year, and see where he sits. But because everyone's situation is so different, it's really hard to, I can't give you a quote unless I get your Schedule F. Some people don't want to give you, I get why you wouldn't want to give me your Schedule F either. That's a trade-off for this one. It's easy to quote. I just need the 5 years of Schedule F, and then you have to give me just a real quick, I'm going to grow 1,000 acres of corn at this yield, this price, 500 acres of soybeans, this yield, this price. And we can knock a quote out. Questions on that? Well, thank you for coming. We had hats and little notebooks back there before. If you'd like one, let us know. They're still back there. Grab one on your way out if you want. Grab a cookie on your way out. And again, thanks for coming.